Welcome back to the next session on reinvent income tax. For next session, we have Bharadwaj Seshadri. May I request Shivraj to welcome the speaker onto the dais and welcome him with the floral bouquet. Bharadwaj Seshadri is a qualified chartered accountant. He has a bachelor degree in commerce and law. He practiced as a chartered accountant between 2015 to 2018. He enrolled as an advocate in April 2019 and has been practicing advocacy since then. He began appearing before the Commissioner of Income Tax at the age of 21 and before Income Tax Appellate Tribunal at 23. He presently practices before those authorities and tribunals: the Appellate Authority under the Indirect Tax, the SESTAT and the High Court of Karnataka, and as briefed eminent senior counsel, he has reported orders of the High Court of the Karnataka and the Income Tax Appellate Tribunal to his credit. His area of practice extends to drafting as well as consultancy in the matter related to commercial contracts such as the income tax law, the service tax laws, the GST, company law, PEMA, etc. He has a keen interest in writing and speaking and has multiple published technical and non-technical articles to his credit. He is an assistant editor for the Company Law Institute of India Private Limited and authors endnotes for their journals of Income Tax, GST and Companies Act. He has co-authored the part 3rd edition of the book Trust by C.R. Rao, published by Messrs. Pulani and Pulani. He has been a judge for various moot court competitions. Outside the profession, he has deep interest in Carnatic music and is generally curious about Indic field of knowledge. With this brief introduction, I present to you Bharadwaj Seshadri. Over to you.
Having invited me to speak today. My thanks in particular to Mr. Kota Srinivas for having given me this opportunity. He has kept me quite busy. Yesterday he took me to Chikmagalur to speak for the Udupi branch, and now he has me here speaking today. I will not admit to being tired, but I am a little tired. I also will not be surprised if all of you are a little tired, considering that you have just come after lunch. Having said that, the subject of charitable trust you need to be a little crazy to enjoy it. If you enjoy it, there is much to be enjoyed. On the other hand, if you don't, it can be quite drab. When he invited me to speak, I was given very strict instructions that I must not go into things in great depth. In fact, he went so far as to say that I should not refer to too much case law. This is all much against my instinct, but I will do my best to restrain myself and to honor his request. Feel free to intervene at any time with questions or also correct me if I am wrong. This income tax law and charitable trusts is a little problematic because the foundational first principles that you need to be conversant with to understand the law are neither clearly in the accounting realm nor in the taxation realm. It is not like the computation of income under the head business or profession, for example, where you begin with the profit as per the profit and loss account and make adjustments for all the allowances and disallowances that the Act contemplates. That is ordinarily how you compute taxable income under any head. On the other hand, it is not like accountancy either, where it is only commercial principles that dictate what goes to determine your profit or loss. It is somewhere in the middle. To give you an example, there is a long line of decisions, including of the Supreme Court, holding that the word income for the purpose of section 11 is not the same as total income for the purpose of the other provision of the Act, and that it is not the same as total income as defined in section 2. Having held so, the courts have gone on to hold, therefore, that income under section 11 is to be computed as per commercial principles. The law has gone so far down this path to hold in Jaslok Hospital's case, an unreported order of the Mumbai Tribunal, that even provision for doubtful debts can be claimed as a reduction in computing income under section 11. This is of course now subject to various other caveats which we'll go through in the course of today's seminar. Similarly, the computation of income under sections 11 and 12 does not particularly respect the difference between capital and revenue items. This also we will see a little later, but to give you one example, until subsection 6 of section 11 was inserted, you could claim both the capital expenditure as application and also the depreciation on the asset, on the same asset of which you claim the capital expenditure. So the distinction between capital and revenue is also sort of blurred. So any mature understanding of the law on this subject can only begin if you clean the slate as to your instincts, both in terms of accounting instincts and income tax instincts. With that prelude, let me begin. There are about 10 sections in the Income Tax Act which deal with the subject of charitable trusts. Section 11 is the foundational section which confers the exemption. Section 12 deals with particular kinds of incomes or receipts, for example, voluntary contributions and certain non-cash or non-monetary incomes. Section 12A, this sets out the conditions subject to which you are allowed exemption. That is, if you do not satisfy the conditions in section 12A, you will not be entitled to exemption. Section 12AB deals with the procedure for registration. Registration itself being a condition under section 12A. Section 13 deals with the cases in which you will lose exemption. These are the five or six principal provisions. Besides this, there are certain special subsequent provisions such as 115 BBC dealing with anonymous donations and 115 TD, TE and TF which deal with the subject of accreted income. Finally, subsection 15 of section 2 which defines the term charitable purpose. It therefore makes sense to begin by reading section 11 subsection 1 clause A and consequently the definition of the term charitable purpose. Section 11 reads, income derived from property held under trust wholly for charitable or religious purposes to the extent to which such purposes are applied, such income is applied to such purposes in India. These are words which are absolutely pregnant with meaning. There is not a single word in this sentence, in this passage, that has not been the subject of considerable judicial interpretation. I have already dealt with the word income to say that it is not the same as total income and so on. Property, the Supreme Court considered what is property in P. Krishnavariyar 56 ITR, in which the Supreme Court said that the term property is so wide that it will include even businesses held under trust. Therefore, the term property is of the widest import. Under trust, the phrase under trust, oddly enough, finds a definition and an explanation below section 13. And there trust has been defined to include a legal obligation. Let us take the instance of a mutt, for example. Under the Hindu law, a charitable or a religious endowment is established by two processes. The first is sankalpa and the second is utsarga. If you perform these two processes and set apart some property or dedicate some property for certain purposes, in the Hindu personal law, an endowment is thereby created. Now, had explanation to section 13 not defined trust to include a legal obligation, Hindu obligations or endowments settled through the Hindu personal law would not have come within the scope of these provisions. It is to facilitate this that definition exists. Therefore, the term trust is not to be understood as only meaning English trusts, but also any other obligation, any other property to which there is a fiduciary obligation of some kind attached. Wholly for charitable or religious purposes. The term religious purpose is not defined in the Act. That is to be determined as per the principles of the relevant religion. Therefore, if the trust or institution in question is a waqf, then you will appreciate the Sharia law governing waqfs to determine whether it is a religious purpose or not. And if similarly in the case of Hindu law, I already dealt with that example. Charitable purpose, on the other hand, is defined in the Act, and there has been considerable dispute on that definition, including two very important recent decisions of the Supreme Court in Ahmedabad Urban Development Authority 449 ITR 1 and New Noble Educational Society 448 ITR. So this is clause A of subsection 1 of section 11. Clause A, most importantly, states that it must be held under trust wholly for charitable or religious purposes. Clause B deals with cases where a property is held under trust only in part for charitable or religious purposes. I will not go into that because there are very few instances of that today, and the law on that is again quite complicated. Clause C deals with certain specified charitable purposes that are prosecuted outside India. You will note that clause A says that the purposes must be prosecuted in India. Clause C deals with cases outside India. That requires the approval of the board. So once again, you will not see too many cases of that. I won't deal with it. Clause D is particularly significant. Clause D deals with voluntary contributions with a specific direction that they shall form a part of the corpus of the trust of the institution. If I make a donation of 100 rupees to a trust today, most of you will be aware that the gross receipts of a trust or the income of a trust, there is a distinction between these two terms I will come to later, but 85% of the income of the trust is to be applied to charitable purposes. But that requirement for application applies only to clause A of subsection 1 of section 11. It does not apply to corpus donations falling within clause C. This is why it is relevant to know how a donation is constituted to be a corpus donation. We use the term corpus donation colloquially, but clause D states, the language of clause D is voluntary contributions with a specific direction that they shall form a part of the corpus of the trust. So first, the contribution must be voluntary, and secondly, the contributor must direct that it is attributable to the corpus. A simple letter or any written communication would suffice. There is nothing in the law to suggest that even an oral instruction is not sufficient, but it is hard to evidence in the course of proceedings. Written communication is better. Various recent amendments have been brought about which will affect the position of corpus donation, but I'll be dealing with that at a later stage. Now we come back to the foundational question of what is a charitable purpose. Subsection 15 of section 2 is on your screen. Let us read that. Charitable purpose includes, therefore the definition is inclusive, it is not exhaustive. There is a logical fallacy here in the statute, but again we will ignore that. Relief of the poor, education, yoga, medical relief, preservation of the environment including watersheds and wildlife, forests and wildlife, and preservation of monuments or places or objects of artistic or historic interest. There are 6 limbs which I have read, and then there is the 7th limb, the advancement of any other object of general public utility. These first 6 limbs, colloquially we have been referring to them as the main limbs, and the last limb we have been calling the residuary limb. The Supreme Court in Ahmedabad Urban Development Authority has called the first 6 limbs as being per se charity and the last limb being GPU charity, GPU standing for general public utility. The importance of the distinction between the main limb and the residuary limb is to be seen from reading the proviso. Provided that the advancement of any other object of general public utility shall not be a charitable purpose if it involves, so it says it shall not be a charitable purpose. So the proviso is creating an exception to the general rule. If it involves the carrying on of any activity in the nature of trade, commerce or business, or any service in relation to such trade, commerce or business, for a cess or fee or any other consideration, irrespective of the nature of use or application or retention of such cess fee or other consideration. Let us stop there. The ingredients for the proviso to apply can thus be summarized as follows. First, you have to fall under the residuary limit. If you fall under the main limit, it will not apply. Second, there has to be some activity in the nature of trade, commerce or business or service in relation thereto. Third, that activity must be for a consideration, cess or fee. And fourth, it is not relevant how that consideration is ultimately applied. The Supreme Court in Tandi Trust's case was dealing with a case where the trust was carrying on the activity of running a newspaper, that is the Tamil daily Dinantandi. And the terms of the trust were such that the profits generated out of such activity were to be applied exclusively for the purposes of education, for funding an educational institution. The question before the Supreme Court was that the trust was carrying out commercial activity in substance. It is just that the income or the profits ultimately were being utilized for charitable purposes. The Supreme Court held, in my view, with deep respect correctly, that the relevant factor is the purpose for which the activities are being carried out and not the activities themselves. And since the profits are being applied for education, Tandi Trust must also be held to be prosecuting the purpose of education. The implication of this decision is that indirect charity, that is, if I am carrying out a business, the profits of which are appropriated to charitable purposes would also constitute the prosecution of a charitable purpose. Similarly, if I am a charitable trust carrying on charitable activities myself, and I choose to donate or pass on some of my monies to another charitable trust, that too would be a charitable activity. There are some caveats to this which again we will come to later in dealing with the computation of the income of a charitable trust. Now, this view in Tandi Trust was expressed in the context of education, which you will appreciate is a main limb and does not fall within the residuary limb. The question now is whether the same logic will apply for the residuary limb. The answer is no, because of the last few words of the proviso, which says that irrespective of the nature of use or application or retention of the income, the advancement of any other object of general public utility will not be a charitable purpose. So you cannot carry out an activity whose object falls within the residuary limb, say that the profits therefrom are only being used for charitable purposes, and get away from the applicability of the proviso. By and large, therefore, if you fall within the residuary limb, it is very, very difficult for the proviso not to apply. And this conclusion that one charity feeding another or business feeding charity is not charitable in the context of a residuary limb charity has been upheld recently by the Supreme Court in Ahmedabad Urban Development Authority. Now, if we look at how when section 215 was originally enacted, it read, charitable purpose includes relief of the poor, education, medical relief, and the advancement of any other object of general public utility, not involving the carrying on of any activity for profit. In this context, there are three decisions of the Supreme Court, one in Sole Trustee Loka Shikshana Trust, the second in Indian Chamber of Commerce, both of which are not particularly relevant. The more relevant decision is the decision of the Constitution Bench in Surat Art Silk Cloth Manufacturers Association, I believe it is 127 NTR. My memory is not very good, so my citations may be wrong here and there, but all judgments are only one Google search away, so I suppose you will excuse me. The Supreme Court in Surat said that not involving the carrying on of any activity for profit, the words for profit the Supreme Court held means that what is the test? The test is whether there is a profit motive or not. So, if I am carrying on activities within the residuary limb, and as per Surat, if I do not have a profit motive, then I will continue to be charitable. It is this judgment that the legislature sought to overrule by inserting this proviso, although it was inserted in a few avatars before this, there have been subsequent amendments too. In the proviso, therefore, the words for profit or any suggestion concerning profit motive are completely absent. The words used are any activity in the nature of trade, commerce or business. Now our common understanding, including for example for the purpose of what income will be charged under section 28 as opposed to 56, our common understanding of what constitutes business is that there must be profit motive. Our common understanding of what is commercial is the existence of profit motive. Therefore, when we see the words trade, commerce and business, our first instinct is to test whether there exists a profit motive or not. And if there does not exist a profit motive, we reach a conclusion that it is not trade, commerce or business. In fact, even after the proviso attained this form, various high courts and also various benches of the tribunal have been applying pretty much the same test. This, in my respectful submission, is an incorrect statement of the law, which has been corrected now by the Supreme Court in Auda case. In Ahmedabad Urban Development Authority, the Supreme Court impliedly observed that when the legislature omitted the words for profit and instead inserted the words activities in the nature of trade, commerce or business, the intention of the legislature was to remove profit motive as a test to determine whether the proviso will apply. So therefore, today, if you want to find out whether the proviso applies, the test of profit motive is wholly irrelevant. The question then is, if you take profit motive out of trade, commerce or business, what remains? The Supreme Court in Auda has gone on to clarify that. Supreme Court has observed that trade, commerce or business means that there must be frequency, volume, continuity and regularity of activities. Therefore, if you carry out activities in a systematic manner and in a regular, frequent, continuous manner, even if the activities are not with a profit motive, they would constitute trade, commerce and business within the meaning of the proviso. Now, there is hardly any trust which will not satisfy this requirement, because virtually any organized activity will constitute trade, commerce or business. Now the Supreme Court in Auda, when you read the judgment, you can see how the judge was thinking. This much reasoning was laid out, and then the judge discovered that if you do this, trade, commerce and business will become so wide that it will become all encompassing and every trust will be carrying out trade, commerce or business. Then to correct this problem, the Supreme Court, when it was interpreting the term fees, cess or consideration, also dealt with trade, commerce or business again and said that ultimately to constitute trade, commerce or business, there must be a substantial markup. It actually said it negatively. It said that if there is no markup or if the markup is marginal, the activities cannot be said to be in the nature of trade, commerce or business. There is another bit of reasoning the Supreme Court used. The Supreme Court said that what is contemplated by the proviso is not trade, commerce or business, but activities in the nature of trade, commerce or business, and in the nature of X would be X plus something. That is the reasoning that the Supreme Court used to remove profit motive as an ingredient. Therefore, the test to determine today whether there exists trade, commerce or business is whether there is a marginal or no markup on the one hand, or there is anything else. If there is a marginal markup or if there is no markup, you can safely conclude that there is no trade, commerce or business, and vice versa. Your natural follow-up question ought to be, what is marginal? The Supreme Court has not gone ahead to clarify that, in my opinion wisely, because it is impossible to lay down one plimsoll line across all charitable purposes or activities to say that something is marginal and something is not marginal. The effect of all this is that the law has become a little more complicated. If both you and the assessing officer will admit that your margin is 10%, assessing officer will say that 10% is not marginal, you will say that 10% is marginal. The dispute will be resolved at the minimum at the tribunal. One member of the tribunal will think it fit to say that 15% is marginal, anything above 15% is not marginal. Then there will be 25 judgments following that order of the tribunal. One of that will go to the High Court and that will get disturbed. So there is no end to this. If any of you are familiar with transfer pricing and the application of the turnover filter in the software development services segment, This is precisely what is happening, whether you should apply the 1/10 to 10 times or the range basis. So this is the litigation that I foresee. In fact, we have dealt with cases where this question of whether my surplus was reasonable or not has already been, the assessing officer has already said that it is unreasonable and therefore denied exemption to a trust which is functioning under the main limbs, which is quite ludicrous because where is the question of reasonableness of profits under the main limbs? And so this is what AUDA has held.
A question, sir.
Yes, sir. Yes, ma'am.
Wherein it is in the main limb, the charitable trust is in the main limb, and they are doing the commercial activities also. For example, they are self-help women group who are into education, main limb of educating the women group and getting their service, selling the articles manufactured in that process. Does it fall under the trade and business activity, or it is since it in the prime limb, it will be known as charitable?
I would dispute the premise that that is under the main limb at all. Because I was going to deal with this later, but I'll deal with it now since you put the question. The question is what constitutes education? You tell me any given activity, I can give you case law for and against it saying that it is and is not education. There is a lot of judicial confusion also. There is Mr. S. Rajaratnam's book, Landmark Cases, one 3-volume book. In that Justice Krishna Iyer has written a foreword saying that in India there is case law which cancels each other out. And Mr. Narendra Jain's book on case law and transfer pricing, Mr. G. Sarangarnat, senior counsel, has written a foreword saying that India is the largest exporter of case law. But nevertheless, on this question of what is education, there is a lot of confusion. In one of the decisions which I refer to, Locus Shikshan and Trust, Justice H.R. Khanna, in a separate opinion, in one opinion in that case, said that education must be interpreted only as scholastic education. That is, either you are in school, affiliated to a university, college, etc., or you are not education at all. Because Justice Khanna's reasoning at that time was, if you are walking on the street and somebody picks your pocket, you learn a lot about life from that experience, can that be considered education? So, this, of course, I must point out that Locus Shikshan and Trust was overturned in subsequent decisions. But broadly, if I will not trouble you with all the case law, broadly the principles are this. There is no need for the institute to be affiliated to any board or university for it to constitute education. 1. 2. The most important test is whether there is control of the teacher over the taught. For this reason, private coaching classes do not constitute education. Because as a CA student, I voluntarily pay the fee and go and attend there. If I choose not to go tomorrow, I am not affected by that. There is no control of the teaching over the taught. In my view, this is the strongest test. Then, it is not only scholastic education that constitutes education. But it is very difficult to say that these things constitute education. You have to evaluate it on a case-to-case basis. Yes, one more tiny one. There is a judgment of the Bombay High Court in Haid Consultancy Services, Justice V.C. Dara. He was dealing with the question of what is capital and what is revenue. He said there are many tests to determine whether an item is properly attributable to capital or revenue, but most of those tests are faithful servants, but as masters they can be over-exacting. That is precisely the problem here. You cannot say this is the test, this test is passed, or the case passes the test or fails it, therefore it is education or not education. Fundamentally it is very subjective and abstract. In my view, I am familiar with the SNG kind of operations. Most often, it is very difficult for me to conclude that it is education. So it will fall under the residual limit. And consequently, this could be in the nature of trade, commerce or business. I assume that the products are being sold to third parties or only within the groups.
Third parties or
The SNGs produce and it is.
sold. For example, even corporates get the products. For example, reusable
Right.
sugarcane waste and all will be used for the paper manufacturing or dairy they make, which corporates they buy it as part of their social.
So each group is registered as a trust?
No, this is just one of the examples which I.
No, so this, it's very hard to
So it
say.
will come under the second.
Broadly, yes. Yes, ma'am.
So what about vocational training?
Now, there is case law both ways. In my view, it is not education. That question has been considered. On the other hand, you need not be carrying out education to come within the limit of education, funnily enough. Tandi Trust is an example which I gave earlier. There are also a couple of Delhi Assam textbook association or something like that. Various charitable trusts which print and publish textbooks for schools, they have all been held to be in the nature of education. Vocational training, most often it is not education. Since these questions are coming up, if you look at the extent of the compliance burden on charitable trusts registered under Section 12AB today, there are more situations in which we advise clients to simply set yourself up as a for-profit enterprise rather than claiming an exemption. There are some theoretical obstructions to that, but you should be able to deal with it properly. If you're earning a substantial surplus, then probably you aren't managing your affairs well enough because the gross receipt ought to be applied anyway. What are you doing with the surplus? So most likely you will be earning not too much of a surplus, in which case simply pay tax thereon. If you're running a deficit, there is no difficulty. So considering the compliance burden and also the attitude of the department in assessments of trusts in the last 6-7 years, the justification for registration under 12AB is becoming less and less advised. Now we were considering AUDA. Now when AUDA goes on to record various findings concerning various specific classes of entities, the ICAI was one of the parties to that case which has been dealt with. All that is a matter of detail which, as I said in the beginning, as per Mr. Kota Srinivasa's instructions, I will not be going into. Now charitable purposes. Traditionally both in India and in England, charity and religion are virtually inseparable. Charity and religion are almost always the same thing. And there is quite some very interesting discourse on how Section 215 came to be what it is from, say, 1601 British Statute of Elizabeth and so many other things. We won't get into that. But so I have already discussed the subject of the main and residual aliens. I have already touched upon very briefly the evolution of Section 215 and the relevance of the profit motive and the decision of the Supreme Court in AUDA. What remains is the last point of this slide, which is the eleemosynary element. When Justice M.C. Chhabra wrote a judgment, the judgment is timeless until the law is amended. And very often, even once the law is amended, the judgment still sheds light on the law. One such judgment is Commissioner of Income Tax versus Breach Candy Swimming Bath Trust, 27 ITR 279. There, Justice Chhabra stated what was already well known in the British law and in India, that the eleemosynary element is not necessary to constitute charity. Eleemosynary element means giving something for nothing. To be charitable, it is not necessary that you give out free dole of any sort, or that you conduct whatever services you render for a discounted price or for no consideration at all. This is not a test of charity. The only test of charity is the absence of private gain. This is what Breach Candy has held, and our High Court recently in the sense 7 or 8 years ago in CMR Jnanadhara Trust's case has also followed Breach Candy. So this is very important because some of us have the misconception that if you are doing something, only if you are doing something for a subsidized rate is it charity. This is a misconception which we must be disabused of. Now, education I have already dealt with. Relief of the poor. This is the first main limb. The only important point to understand here is that there is no plimsoll line to say that these people are poor and these people are not poor. Under the Income Tax Act, there is no need, in order to establish that you are doing charitable activities exclusively for the poor, you do not need to establish that all of them have BPL cards, for example. Now, I do not recollect immediately if there is case law to this effect, but this appears to be the proposition in law. At the same time, you must be able to evidence somehow that there is the people you are serving are not well to do otherwise. I know the example of one charitable trust which operates in various states, which again operates on the basis of the SHG model, in which each member of the SHG is classified into three economic classes: subsistence, sustenance, and something else, S1, S2, and S3. And once they graduate from level to level as they are relieved of poverty, and once they climb out of the last stage, the charitable trust no longer does work for their benefit. So we must also remember that section, the test for whether you are entitled to exemption is not the nature of your income but the application of your income. So if you are tomorrow in an assessment proceeding asked to demonstrate that you are charitable, you should be able to show how you applied your income and where. And if you claim to fall under relief of the poor, there must be substantial evidence to demonstrate that your beneficiaries broadly are poor. So this is one important dimension. Next, you see campaign organizations, research organizations, etc. If you look at activities like preservation of the environment, that these objects are typically prosecuted by activist-minded organizations. And many of these activist-minded organizations' primary operations is not, for example, planting trees, but say raising awareness on environmental issues. The question therefore is whether preservation of the environment would or education or relief of the poor would extend to activism, campaign organizations, raising awareness and activities like that. Broadly, the answer is yes. There are instances where exemption has been granted to according to such organizations. The last aspect is the funding of charity, which I have already discussed, which is indirect charity. The question is whether if one charitable trust funds another charitable trust, can the first mentioned trust be held to be charitable? The answer is yes. This was originally clarified by the board in a circular in 1978, where the board said that donations in favor of another charitable trust would constitute application of income for charitable purposes. There are also decisions of various high courts and the tribunal supporting this proposition. Importantly, there are now a lot of NGOs which carry out, which are funding NGOs. They are fundraising NGOs, they are intermediaries. So there is a website, I want to make a donation, and the charitable trust which is in need of donations does not have access to the donation market. So the charitable trust empanels itself on this website. I make a donation through the payment gateway to the website. The NGO running the website takes this donation from me, issues an ETG receipt to me and passes on the donation to another trust. All this is charitable. And very significantly, there is a decision, there are two decisions there is one decision of the Delhi High Court and a couple of decisions of the tribunal. The Delhi High Court in Hamdard Laboratories has held not just that this would be charitable, but also that the donor organization's classification would be based on the recipient organization's classification. Therefore, if the recipient organization was carrying out education and the donor organization donates to the recipient, the donor would also be held to be in the nature of education. I agree with this reasoning of the Delhi High Court, but this has various practical limitations, particularly if you are a funding organization. Because you may be donating one sum to education, one sum to medical relief. Therefore, you must be able to have sufficiently sound systems to demonstrate that none of those other NGOs are under the residuary limit, so as to protect yourself too. There are practical limitations here. There is also in this context an amendment with effect from assessment year 24-25, which stipulates that where I donate 100 rupees to another charitable organization as a charitable organization, only 85 rupees thereof will be treated as application in my hands. This provision is simple enough to understand when you read the law. However, the CBDT has chosen to issue a circular clarifying this position. As you are all aware, when the CBDT issues circulars, some of them serve the purpose, but they are mostly the exception. Most circulars of the CBDT perform two functions. One is they state the obvious of which none of us had a doubt, And the second is they clarify something which only expands the scope of the confusion and does not actually clarify. Let us find out what has been achieved with this circular. I meant to deal with this a little later, but since the subject came up in the flow of things, I deal with it right now. The first 3 paragraphs are completely irrelevant. Let us read paragraph 4. So, let me repeat. The section 11 now provides that if a trust registered under section 12AB makes a contribution or donation to another trust so registered, only 85% thereof will be treated as application. The matter has been examined with reference to the issues raised in paragraph 3, and it is reiterated. See, when the statute says something, why would you reiterate it in the circular? You must trust the words of the legislature. If you reiterate it here, and there is one grammatical mistake in the circular, it can have disastrous consequences. Anyway, it is reiterated that eligible donations made by a trust or institution to another trust or institution under any of the 2 regimes, the 2 regimes is 1023C and 12AB, referred to in para 2, shall be treated as application for charitable or religious purposes only to the extent of 85% of such donations. So in this sentence, objective number 1 has achieved, which is stating the obvious. It means that when a trust or institution in either regime donates 100 to another trust or institution in either regime, it will be considered to have applied rupees 85 for the purpose of charitable or religious activity. So again, it is an even more eloquent statement of the obvious. But let me tell you how, if you really look at it under a magnifying glass, it will be considered to have applied 85 rupees for the purpose of charitable or religious activity. Which section of the Act says my activity should be charitable or religious? Let us not confuse ourselves. We need not be confused, the board can be confused. It is clarified, this is the clarification. It is clarified that 15% of such donations by the donor, trust or institution shall not be required to be invested in specified modes under section 11(5) of the Act. Let us stop at that point. This is now most of you will be aware that a charitable trust is permitted. Microsoft has very interesting ways of working. I was very afraid that would be Windows update, then the entire thing, I don't know how many of you have faced a difficulty. Anyway. So, charitable trusts are required to invest their monies in the mode specified in section 11(5). The clarification in this sentence is saying that if you have donated 100 rupees and only 85 rupees is treated as application, you are not required to invest at 15 rupees in 11(5). If I don't have it, how can I invest it? Who asked for this clarification? Now, let us go further. Shall not be required to be invested in specified modes under section 11(5) of the Act, as the entire amount of rupees 100 has been donated to the other trust or institution. Obvious. Now here they have ruined things. And is accordingly eligible for exemption under the first or second regime. What is he saying? He is saying that the 15% need not be invested in the modes. Accordingly, it is entitled for exemption. What is the Act saying? Only 85% will be treated as application. Now, what is entitled to exemption? Only something can be exempt only when it is chargeable to tax. Is my expenditure exempt or is my income exempt? So at what level is the conceptual difficulty of the man who drafted this circular? Now, let us read the circular literally. 15% is not required to be invested in the mode specified in 11(5) and it is accordingly eligible to exemption. He has completely reversed the effect of the statutory amendment. If it is entitled to exemption, then why was the amendment made? Now, since we are now very worried after reading this paragraph, we will see the illustrations clarify anything. I can give you a spoiler and tell you that you can be rest assured they do not clarify anything. I have created illustrations of my own to presumably arrive at the correct position. I mean, this illustration, I cannot imagine that somebody came up with these illustrations in all seriousness. It is quite comical. There are three illustrations, we will go one by one. Let us start with trust number 3. 100 rupees is the gross receipts. Therefore, 85 rupees is required to be applied, no difficulty. 100 rupees is donated to another charitable trust. Therefore, 85 rupees of that is treated as application. Therefore, the whole of the income is exempt. Would anybody have had a doubt about this? Answer is no. Trust number, that is trust number 2. Trust number 2, I apologize. Trust number 3 is an even more ludicrous example where there is no application in favor of another charitable trust at all. 100 rupees is the income, 85 rupees is required to be applied. Serial number 7, application other than in favor of a trust is 85 rupees, therefore it is required to apply 15. This has been the law since 1961, except that 15% will be 25%. So trust 3 has nothing to do with the question at hand, not relevant. Trust 2, I have already dealt with, I made a mistake. But trust 2 is very clear. All my income of 100 rupees has been applied, 85% will be treated as application. I am entitled to accumulate 15% under 11(1), no difficulty. So we must hope that trust 1 gives us some clarification of views. 300 rupees. Now, this is the trust 1 is the example which is actually the most relevant, even though it also does not clarify anything. They could have used 100 rupees in all three. 300 rupees is the income. Out of that, 85% is to be applied, which is 255. 100 rupees is donated in favor of another trust, which means 85 rupees is treated as application. 255 minus 85, 170 is the balance which is to be applied. We would have hoped that something less than 170 is applied, but no, 170 has been applied in the normal course. So your application requirement is satisfied. No question is answered in this illustration also. So we have concluded that the circular does not substantially add to our knowledge. Let us see what we can do with the circular. Gross, I must begin by saying that I use 300 because the circular used 300, otherwise I would like to use round figures multiples of 10. So please don't hold that against me. We can look at only one of these two illustrations. We'll start with 300, 85% of that is 255, normal application is 170, application in favor of a trust is 80, application allowed is 85% of 80, which is 68. The total application is 170 plus 68, which is 238. But 255 ought to have been applied. Therefore, there is a shortfall of 17 rupees. Now, how much have I actually received? 300. How much have I actually applied? 170 plus 80, 250. Which means I have 50 rupees of cash in my hand. 15% accumulation under 11(1)(a) of 300 will be 45 rupees. Which means out of the 50 rupees of cash in my hand, accumulation to the extent of 15% is covered to the extent of 45 rupees. I have only 5 rupees left, which means out of 17 I am able to accumulate only 5, 12 would be taxable. This is my understanding of the statute. What is the circular saying? This 17 need not, this 12 need not be held in the mode specified in 11(5), therefore it is entitled to exemption. So if you apply the circular, this 12 would also be entitled to exemption. It is my function in sessions like this to clarify things and presumably enlighten you on the courageous presumption that you are not already enlightened as to the law. But I am a servant of the law. This is what the law says, so I leave it to you to understand what the import of the provision is. So this addresses that last point of funding charity. There is some typographical error in the heading. Anyway, no, there is no typographical error. There is some. Grant of exemption, basic principles. So we have already discussed the concepts of income, property, trust, and wholly for charitable or religious purposes, what is income and how income is computed. On how income is computed, I wish to deal with it in just a little more detail. I have already referred to the decision of the Supreme Court in Breach Candy Swimming Bath Trust. There is also a decision of the Madras High Court in Rao Bahadur Kannan Chetty Charities. I forgot the citation. It is a judgment of Justice Sethuraman, who was earlier a member of the tribunal. I think it must be in the late 70s or early 80s. That is a beautiful judgment to read if you are a student of the income tax law and want to understand how to compute the income of a charitable trust. Because first the judgment explains it in prose, and then it actually sets out illustrative computations of how it is to be done. And there is absolutely no error in that judgment. One does not expect that. And the only difference is there have been some amendments in the statute since then. To that extent, the judgment may not be of assistance. But overall, to understand the structure of the provisions, it is a good idea to read the judgment. One of the amendments, for example, is what we know now as 15% and 85%. Earlier used to be 25% and 75%. So that is recommended reading. Rao Bahadur, Kandan Chetty Charities. Now, this is broadly the mode of computation. This term gross receipts is not actually used anywhere in the statute, but you will find it appearing in the income tax return form. It is also a term that we have been using and the courts have also been using to deal with this computation. One of the most fundamental questions that was repeatedly arising is whether this 15% accumulation or the 85% application would be computed on gross receipts or income. So what is the difference between gross receipts or income? There are various stages in the computation of the income of a charitable trust. When you are computing the income of a charitable trust, you are not in fact computing the income, you are quantifying the exemption. There is 100 rupees which I receive as donations. I have incurred administrative costs to collect those donations. Those administrative costs are therefore expenditure incurred for earning income, which is a phrase we are all familiar with both in section 57, section 29, etc. In any computation of income for tax purposes, you will deduct expenditure. Income is net income, that is all fundamental principles. Once you arrive at this income, you have to apply this income to charitable purposes. This application is what we would call a below the line item. It is appropriation of the income, it is not. So if I was talking in commercial principles, it is an appropriation of profits and not a charge on profits. Now, the question is whether you will compute this 15% accumulation or the 85% application on the gross receipts or the income after deducting the expenses incurred on earning the income. Now, this gross net issue has arisen in a number of cases. There was a period of time, I think from assessment years 11, 12 to 14, 15, in many cases this was picked up. And the assessees ultimately succeeded in saying that 85% must be on the net income. So there is a problem here. There is a judgment of the Supreme Court in Program for Community Organization which answers this question. I do not want to comment on exactly what it says. It's only a 3-paragraph judgment. I would request you to kindly read the judgment. Everybody has been following that judgment to say that the 15% 85% should be computed on net income, but that is not exactly what the judgment says. There is some confusion, but this issue exists. However, these days the assessing officer is not, at least in the last 5 or 6 assessment years, I have not seen this issue being picked up. So, gross receipts, expenditure on earning the income, then 15% accumulation, then disallowances. In view of certain recent amendments to section 11, 2 disallowances which govern the computation of profits and gains of business and profession, namely disallowances for under section 48(3) and 48(1)(a) for non-deduction of tax at source and for payments otherwise than by account pay. Yes, sir.
So the 85% definitely it should be on the gross receipts. Why? Because if you take net income, the capital expenditure will not be taken. Actually, capital expenditure is also included in that 85%. Normal.
Okay, so I have understood your point.
Yeah.
There are 3, 4. Yes, sir.
No, basing on that only the 85% because the capital expenditure, how can we treat it as net? For net income, we cannot get it as a capital expenditure.
So, program for community organization said exactly what you're saying, Supreme Court. They did not refer to this capital expenditure reasoning. That reasoning is incorrect, as I will point out just now. The problem is, the words used in section 11(1)(a) are income to the extent it is applied to charitable purposes of India to the extent of 85%. Madras High Court, in my view, correctly has held that income is income after deducting expenditure on earning income. And in the illustration in Condensity Charities case, 25% at that time, which is now 15%, was computed on income and not on gross receipts. In my view, that is correct. But the Supreme Court has held that gross receipts are, you have to compute it on gross receipts. But even that, the Supreme Court has not held very clearly. Department has been agreeing with the assessee's view now on the basis of program for community organization. On your specific point on capital expenditure, you are right in saying that capital expenditure would constitute a part of application, but now subject to 11(6), either you claim depreciation or capital expenditure. So subject to that one write-off. But irrespective of whether you compute it on gross receipts or on net income, you will be treating capital expenditure as application, assuming you are not claiming depreciation. Then from an assessee standpoint, presumably you stand to benefit if you compute it on net income because then the 85% is met at a lower level. Conversely, if the 15% is also computed on a lower level, so there is no, what benefits the assessee and what goes against the assessee here is not very clear. But everybody is now computing on gross receipts as you have pointed out.
So with net income, then what will be 85% again after net income?
Right. So, sorry sir, I have now understood your confusion as to what is net income. Is net income what you arrive at as the surplus in the income and expenditure account? Theoretically, there is a huge gulf between theory and practice. Theoretically, you have to consider all your outgoings and separate what is expenditure for earning income with what is application for charitable purposes. So, in an educational institution, the salaries you pay to teachers would be application for charitable purposes, but the salary you pay, for example, to a chief executive officer for administering the organization may be expenditure for earning income and not application for charitable purposes. This is the level of theoretical complication which the Madras High Court has appreciated. But neither the departments nor the assessee look at things in this depth. So, today, in practice, there is no distinction between expenditure on earning income and application. And probably practically it is safer to proceed on that basis. So, as I said, have I satisfied your question, sir? So, as I said, now two disallowances which are applicable in computing business income, that is 48(3) and 48(1)(a) are now applicable to charitable trusts too. Until assessment year 2021-22, there were various orders of the various judgments of high courts and orders of the tribunal holding that where you had excess application in earlier years, that is where your application exceeded your income, that deficit can be brought forward and claimed as application in the current year. With effect from assessment year 21-22, the statute has been amended to prevent you from doing this, so there is no question of bringing forward a deficit. For what it is worth, my view is that the statute is correct, because if you look at the benefit of set-off and carry forward of losses under the section 70, 71, etc., all 72, all those provisions, all those benefits would not have existed but for the statutory mandate. The benefit of setting off a loss is not something which you see in computing income or commercial principles or in even for accounting purposes. It is an artificial benefit which the statute must confer. Therefore, in my view, the decisions in favor of the assessee before this amendment were incorrect. But anyway, now the law is clarified. So you are obliged to apply 85% of, consequent to sir's question and just to make things simple, gross receipts to charitable purposes. What happens if you don't apply? Now we will see how the bureaucracy makes the law more complicated. You have two options. One is accumulation under section 11(2), for which you must file form 10. Form 10, earlier, there was a time limit prescribed in the rules. The Supreme Court in Nagpur Hotel Owners Association, this is Santosh Hede's judgment, said that there is no provision in the Act which empowers the rules to prescribe a time limit. Therefore, Form 10 can be filed until the completion of the assessment. Then, the statute was amended to provide that Form 10 must be filed at or before the due date for filing the return of income. Now it has been amended to say that it must be filed 2 months before the due date for filing the return of income. If you file Form 10, you are permitted to accumulate for 5 years. That is only now. Earlier, so your accumulation is under section 11(2). If you accumulate and then you don't use it for the purpose for which it is accumulated, or there are certain other violations specified in subsection 3, then it will be brought to tax in the year in which such violation occurred. However, the subsection 3 used to say that if you have accumulated it and not spent it in 5 years or in the immediately succeeding previous year, it shall be brought to tax. Which means 5 years was effectively 6. It was not actually 5. Now that has also been amended to say that 5 years is only 5. I don't really have a complaint with any of these amendments. Why do I not have a complaint with an amendment that everybody is complaining about? Which is, why is Form 10 now required to be filed at least 2 months before the due date of filing the return? Because until now, 11(2) accumulation was used as a balancing figure. You will draw up your income and expenditure account just before filing the return, discover that this much has not been applied, and then say that no, I have accumulated that much for application in future years. I wonder if there was a single board resolution for accumulation under section 11(2) which was not antedated. The intention of the provision is that if you are accumulating, he will give you the benefit. It is not that I want the benefit, therefore I will accumulate. This is presumably the justification for advancing the due date to 2 months before filing the return of income. But I have a broader problem. See, I can deal with the statute all day, but for my own pleasure, you must permit me to express some opinions here and there. Not that I haven't been doing it thus far without your permission. Now, I have a broader problem with the entire structure of things. I have to apply 85%. If I am not applying, I am entitled to accumulate. Why should you just not allow me to accumulate? You anyway have control over it, because in every year's return of income, the amount is shown for the past 5 years. I have to spend it and you bring it to tax later. All that is happening is that you are deferring the tax incidence by a few years. Why should I file a separate form? And why should there be a time limit for that form? And everything that is done to, most things which are done only increase complications. I don't know if you have read orders of the Supreme Court granting and declining to grant special leave to appeal under Article 136 of the Constitution. 8 out of 10 orders you will read will say delay condoned, leave granted. Only 2 out of 10 will not condone a delay, because in 8 out of 10 cases there will be a delay. So when this 2 months time period was stipulated, immediately all Form 10s were belated. Once it is belated, there is no specific dispensation for condonation. So everybody filed applications under section 119 to the board. Now the board is sitting at the topmost level of the hierarchy, so they have to do the least work. So then immediately they discovered that there is too much piling up on their table. So they issued a slew of circulars. You could have issued one circular and said that condonation of delay in filing Form 10 shall be decided by the commissioner up to an amount of this much and chief commissioner up to an amount of this much. So they issued circular after circular, one each for every form. I mean, there were multiple circulars for delay in filing audit report, multiple circulars for delay in filing Form 10. Each circular was for 1 assessment year, 2 assessment years, 3 assessment years. And I think I have a slide later on. In fact, the number of circulars did not fit on one slide. I had to put them on 2 slides. So finally now you have to see which circular applies and find out before whom you have to go to file the application for coordination of delay. There is a similar comedy of incompetence, not a comedy of errors. Similar comedy of incompetence with respect to the applications for a final registration or approval under 80G or 12AB, which also we will deal with later. Now, this is accumulation under section 11.2. There is also deemed application under clause 2 to explanation 1 to section 11.1, for which you have to file form 9A. Why do two dispensations exist for this? Why would somebody choose form 9A over form 10 when form 10 gives 5 years and form 9A gives only 1 year? The answer actually is a answer with some historical perspective. When 11.2 originally came into the books, it granted accumulation for a period of 10 years. And clause 2 to the explanation, to explanation 1 to section 11.1 was only for 1 year. And if you look at it, there are two subclauses, and one of those subclauses is relevant. Where you have accrued income, but you have not received it, then you are permitted to postpone its application until the year of receipt. This was why there are two different systems. I think that necessity for two different systems is obviated. You can either restrict clause 2 to say only cases where there is approval but not receipt, or you can altogether bring that 2 under 11.2 and deal with things. For many years there was a situation where 11.2 required filing of form 10 and explanation 1 did not require filing any form, so some people would choose to go for that when they were confident that they would apply it in the next year. If you will notice, we have not yet reached the stage of application of income. This is the extent of the complexity in the law. And the joke is that true test for whether you are entitled to exemption is application. Hopefully, I don't remember how the slides go. Hopefully the next slide deals with application. Right. So this distinct gross receipts I have dealt with, distinction between expenditure and application consequent to this question I have dealt with, income we have dealt with. Oh, I understand. There's some problem with the resolution of the screen, so half of it. Anyway, so mode of computation where exemption is denied, section 13, subsection 10. I will come to that a little later. It is easier to understand this provision with the help of an example. Now, this example, first of all, as you must have already see, one of my objectives of speaking until this point was to convince you that the law is extremely complicated. Because if I make a mistake in this example, I can fall back on that complication of the law and say it is not my fault. But if there are mistakes I would like to know, I also did not spend enough time on this example. I drew it up in the last moment. So the first column here deals with the first column here shows the figures as they would appear in the books of account. It has nothing to do with your computation for the purpose of income tax. Computed 1 and computed 2 are two columns where I am showing two alternative methods of arriving at the income. This corpus donation, as I have said earlier, you are not required to apply 85% of your corpus donation within the meaning of section 11(1)(d). Therefore, in computing your income, that will come under a completely separate category and it will not appear in this computation. Next, sale consideration for capital asset transfer. Subsection 1A of section 11 prescribes the method of granting exemption in the case of capital gains. The method prescribed deals with how much of the net consideration you invest, which is something similar to section 54F. But, they say brevity is the soul of good writing. Brevity is not the soul of the income tax law. The computation under subsection 1A is not the same as the computation under section 54F. 54F, it is a simple computation which is proportionate. That proportion of the long-term capital gain, as is proportionate to the investment of the net consideration will be exempt under section 54F. That is not the formula here. There is no multiplication, division, there is only addition, subtraction. So much of the capital gain as exceeds the amount of the net consideration invested or something of that sort. I don't want to go into it in detail, but please be aware that this is the position. If you look at the two alternative modes of computation, in one I have considered the capital gains here, the sale consideration here, and in the other I have not. There are various decisions of the tribunal, I don't think of the High Court. The most recent one is a decision of the Bangalore Tribunal in Al-Amin Educational Society or Foundation or Trust or whatever. I think 2013 or 14 or 17 decision, where the tribunal held that you have an option either to treat sale consideration from capital gains under subsection 1 of section 11 or under subsection 1 and subjected to the same 85% application requirement, which sort of confirms the point that he made, which is that he dealt with capital expenditure, but capital receipts also come into this computation, which goes to the point I made right in the beginning, that this computation is somewhat agnostic to the distinction between capital and revenue. Anonymous donations under 115 BBC, this is subjected to a flat rate of tax of 30%. It is not, I think maximum marginal rate. It is not, you cannot claim application out of it and then claim exemption out of this. This will just be taxed automatically. So, I mean, at this level. So, I deduct expenditure and I derive at the income required to be applied. 85% of this would be the income I would have to apply. Now we come to application. So this is normal operating expenditure. Under any circumstances it will be treated as application, there is no doubt here. Now accrued expenditure. There has now recently been an amendment to the Act under which application can now be claimed only on cash basis and not on accrual basis. Our advice to charitable trusts has always been that do not follow accrual basis of accounting, because there could be a situation, let's assume you are the recipient of a CSR grant, under which in software service companies you have this concept of unbilled revenue. Because the revenue has accrued, but you are not allowed to raise an invoice, it has not fallen due, so you credit it to the profit and loss account and debit it to unbilled revenue. The same thing could arise in the context of a grant under an agreement, where some portion of the grant could have accrued but not been received by you. In that situation, you will not be able to accumulate or apply that amount. You can go under explanation clause 2 to explanation 1 to section 11(1)(a). But the best thing to do is to simply avoid all this chaos and follow the cash basis of accounting, except of course in the case of a section 8 company. Now, as I've said, even application has to be computed only on cash basis.
Excuse me, sir.
Yes, sir.
Since we are on the subject of application, we have a Section 8 company, which is an NGO. It's in promotion of sports development.
Yes.
And they have undertaken various activities of taking deserving people from rural areas and taking their, making them to international sprinters.
Okay.
So there is a likelihood that they have participated in the Asian Games. Also they are targeting the Olympics. This foundation, because in the initial stages you mentioned, applied in India at the beginning when you discussed.
I understood your question.
That's the issue. What has happened, what will happen is that they have been incurring the expenses because they have to travel to various countries, send the competitors for foreign training, buying equipment from abroad, and all this is incurred in dollars, foreign exchange. Whether such expenditure will tantamount to application in India?
In fact, a similar question has come to us two or three times before. If your charitable purpose, say, so for the benefit of, if there is anybody on VC, the question posed is, in the case of a Section 8 company registered under 12AB, which is engaged in the promotion of sport, which inter alia involves the coaching or training of the wards, where expenditure is incurred in that respect outside India in foreign currency, would it constitute application to charitable purposes within India? Sir, my answer is a qualified yes, because it is possible to take either view. Let us ignore this example for a moment. Let us say that I am engaged in relief of the poor. I am registered under the Foreign Contribution Regulation Act. And there are a lot of corporate CEOs these days who in their late 40s leave the corporate world and join or set up charitable non-profit entities. They are typically extremely skilled in securing large quantums of donations from corporate houses both in India and abroad. This CEO of the charitable trust travels outside India, undertakes meetings with various donors and secures donations of large quantums which come to me in foreign exchange and which are duly compliant with the FCRA. His expenditure which I incur there on his travel, stay and other things, or such proportion of his remuneration as is attributable to this foreign trip, would you consider it application for charitable purposes outside India? My answer is no. Merely because some portion of the activities are rendered outside India, you cannot say that the purpose is being prosecuted outside India in its entirety. So my answer to your question is yes, that can be treated as application to charitable purposes in India, but this is subject to considerable dispute. If the AO picks up this issue in 1 year, there is no judicial precedent at this point, and arguments on either side are possible. But if the sports academy in your case is funded by CSR, you have a bigger problem, because if you note Schedule 7 to the Companies Act, promotion of sports there is only within India. Or Rule 4 of the CSR rules, there is a restriction under company law in the context of the CSR for the promotion of sport, where the activity must be in India. So,
The activity is in India. I mean, they have been trained, they have been promoted, but we are taking training from coaches from abroad. We are sending the incumbents for training. So their boarding, lodging expenses, they went to Korea, they came back, all that expenses will be incurred, plus capital expenditures of training equipments and all that. But everything is being conducted and done in India.
yes, so the argument in your favor can be that expenditure is spent abroad to prosecute charitable purposes in India. The argument against you can be that so I'll tell you the reason the difficulty arises. If you read section 11.1, this is 11.1a, income derived from property under trust, held under trust wholly for charitable or religious purposes, to the extent to which such income is applied to such purposes in India. The question is whether the words in India qualify applied or purposes. My prima facie view is that it will qualify applied. But to say then that every single rupee of expenditure incurred by a trust carrying on its activities entirely within India, outside India, would not be application in India is a hyper-technical view. So you will appreciate why I am unable to give you a clear cut.
So
Answer.
thank you very much.
But it can be argued that expenditure is incurred to procure the
Yes.
or which is applied.
No, this is not, you have not, so you are arguing on the basis of the distinction that I drew between expenditure and application.
Because of that only it is going to get the donation.
No, that is not correct. This follows the donation. My purpose itself is to train students, and I am prosecuting that purpose. So it is application to charitable purposes. I don't think that argument can be made. There are very few things which I can answer with certainty. So when I receive a question for which there is a certain answer, I am very relieved.
Take it forward, sir.
Yes.
I mean, what could be the probable preventive steps to be taken when the return is filed in such a situation?
There is. So let me begin this answer with a qualification.
Right.
There are two kinds of questions: questions of law and questions of strategy. Questions of law require knowledge of the law. Questions of strategy require experience, of which I am very deficient. So I am hesitant to give you an answer to that question, but if I won't be held to it. At the stage of filing the return of income, there is no risk. Even at the stage of the assessment proceeding, it is only the question of whether this issue is raised. Even if this issue is raised, it is a question of how the officer looks at it. It is not a clear-cut answer where the officer will take a view against you or will take a view in your favor. If this issue is actually litigated, it is even possible that a high court will take contrary views. And so in situations like this, upon a thorough analysis of the facts of that particular case, you can formulate some view. And this question of risk, as a practicing advocate, I have been trained to never answer what will happen in the proceeding. If the question, one very senior lawyer, I don't want to take his name, he was asked, is this man a good lawyer? He said, he is a good man. I said, no, that's not my question. Is he a good lawyer? No, he is a good man. So when somebody asks me the question, will I win? I will say, no, you have a good case in law. If the judge has woken up on the wrong side of the bed that morning, nothing can save you.
Thank you.
Then capital expenditure. So the position now is that you cannot claim depreciation under section 11(6). You cannot claim depreciation on an asset in respect of which you have already claimed the capital expenditure as application. So you could do an asset-wise decision making, claim capital expenditure in respect of some assets and depreciation in respect of some assets. Theoretically that is possible, practically also it's possible. Do I recommend it? No. Because when you do anything out of the ordinary, it sort of comes to the attention of the department. It's better to avoid this kind of appearances. I will deal with this line item. I understand there is a break between 4 to 4:30. So I deal with this line item and then pause. As I said, only 85% of donations to other trusts are treated as application to charitable purposes. So where I have donated 10,000 rupees only, 8,500 will be claimed as application. I will deal with a couple of more because at least on this computer I have 2 more minutes. I'll stick to it. Expenditure in favor of related persons under section 13, subsection 1, clause C. Section 13, as I said earlier, deals with cases situations in which you will lose exemption. Now, 13(1)(c) states that where you have incurred unreasonable expenditure in favor of a related person, that expenditure cannot be treated as application. The tests for invoking, the procedure or the test for invoking section 13(1)(c) is identical to the procedure or test for invoking section 48(2)(b). And in my considerably limited experience, I have scarcely read an order of a tribunal or high court where a disallowance under 48(2)(b) has been upheld. Mainly because it requires a lot of effort on the part of the assessing officer. He must first identify, it is effectively a mini transfer pricing exercise. He must first identify other similar transactions to determine what is a reasonable amount and establish that this is unreasonable. We do have cases where 13(1)(c) additions have been made. We'll have to see how that turns out. But the point of law which is to be understood here is that if expenditure of say 120 rupees is incurred in favor of a CEO as his remuneration, if 100 is reasonable, only 20 will be disallowed. The whole sum will not be disallowed. Expenditure, now in earlier years you might have accumulated sums, accumulated your deficit of application or resorted to deemed application under clause 2 of explanation 1 section 11(1). Application out of these earlier accumulations, you obviously cannot claim as a deduction in the, I cannot claim as application out of current year's receipts. Brought forward deficits of earlier years, also you cannot claim. With that I'll pause. I suppose we'll reassemble at 4:30. 4:30 now, am I right? Yes. Thank you. I don't think I have a specific, I don't have this line item. So, as we have seen, the computation of income, that is a quantification of exemption, in respect of which you compute the 85% requirement, accumulation under section 11(2), etc., is one computation. The other is in respect of corpus donations under section 11(1)(b), because they are not required to be applied to the extent of 85% at all. the question that had arisen before these amendments is whether where you had applied the sums out of corpus donations, you could treat them as application to charitable purposes to satisfy this 85% requirement. There was, to my knowledge, there is no case law on this proposition, but the answer to my mind is obviously no, because what section 11(1)(a) says is that it must be application of income to charitable purposes, and that income there refers to income under clause A and not income under clause D. In fact, clause D does not use the word income, it says voluntary contributions. However, some trusts were nevertheless making these claims, and somehow it went unchecked. Therefore, the law has now been amended to say that where you have applied monies to charitable purposes out of corpus donations, you can treat them as application only in the year in which you replenish the corpus with other donations, provided that that is within 5 years of such application. Sir, I promised to start at 4:30. I started a few minutes early. If you want me to repeat, I will. So to repeat, in where amounts are applied out of corpus donations, they can be claimed as application only in the year in which that corpus is replenished, if such replenishment is within 5 years of the application of the income. This is alongside another amendment to section 11(1)(d) itself, which now says that all corpus donations must be held in the modes specified in 11(5) in investments held specifically for corpus donations. Therefore, if you have fixed deposits or mutual funds, you must hold, let's not deal in mutual funds, fixed deposits and savings plan accounts. You must hold fixed deposits separately for corpus and non-corpus, fixed deposit and savings plan accounts separately for corpus and non-corpus. And that should be replenished within 5 years, and you can claim it as application in the year of replenishment. Most people saw this amendment as an amendment against the interests of the SSE, because the contention, but my view is, since you are not allowed to claim sums expended out of corpus as application, and now you are allowed to do it, albeit with some restrictions, it is in fact an amendment that helps the SSE. A similar amendment, I came to this because I was dealing with expenditure out of borrowings. A similar amendment has been brought about to in respect of expenditure or application out of borrowings. The law now stipulates, so earlier, so as much as the department is often rather harsh or unjust against the assessee, the assessees also very often tend to play the fool with the law. One such example is the judgment of the Bombay High Court in GKR Charities, in which the question was whether where the assessee had acquired a capital asset out of a loan and claimed that capital asset as application at the time of its acquisition, he could once again claim the repayment of the loan as application. The Bombay High Court said yes. So effectively you are claiming application twice where application has taken place only once. I mean broadly, you could argue either way, but this is the broad consensus. In order to prevent this, now the law says that where you are making application out of borrowed funds, you can claim that application only in the year in which the borrowing is repaid, provided that the borrowing is repaid within 5 years of the application being made. Therefore, if the borrowing is disbursed to you or received by you in year 1, the application is in year 2. Within 5 years of year 2, if you repay the borrowing, in the year of such repayment, you can claim it as application. It is necessary to appreciate the conjoint effect of these two amendments together. Effectively, it appears to be the endeavor of the department now to attempt to identify a one-to-one correlation between receipts you earn and the application of those receipts or the application of income. Because for corpus now you need to have separate investments, and for borrowed funds too, in order to claim the application, you need to be able to prove that the application which you are claiming in the year of repayment was actually made out of borrowed funds. If I make application to charitable purposes in year 2, I repay the borrowing in year 4, I claim year 2's application in year 4, I must prove necessarily that the application in year 2 was made out of the borrowings. Otherwise the claim would not be sustainable. So there is a necessity now to establish one-to-one correlations broadly between receipts on the one hand and application on the other. Corpus donations to other registered trusts or institutions. There is a mischief that was practiced by various assessees. Let us say that I receive 100 rupees of income. See, again I keep hesitating between gross receipts and income. So let us just call it gross receipts. Let's say I receive 100 rupees of gross receipts. I take 85 rupees of this and transfer it to another trust as a donation which is registered under 1280. So I claim 85 rupees application. Here that other trust receives 85 rupees as gross receipts, transfers 68 rupees which is 85% of 85 and claims that as application. This process is repeated in a round tripping kind of fashion. So I mean it does not even have to be a round tripping because it can be a linear so to speak. So if this process is repeated, ultimately there is no actual application to charitable purposes, but the entire income is exempt in everybody's hands. There are various now anti-avoidance measures to combat this mischief. One of them is to say that you cannot make corpus donations to another trust. That is, you can make it, but you cannot claim it as application. This is for the reason that the other trust will claim the whole of the corpus donation as exempt without any obligation to apply it at all. So you cannot claim as application something which is a corpus donation in the hand of the recipient trust. There is an amendment made with effect from assessment year 2003-04 if I remember correctly. When I say I remember correctly, I mean I remember from reading. It's not as if I was around in 2003-04 in practice. So under that amendment, it provided that application in favor of another charitable trust registered under 12AP out of accumulated funds under section 11.2 would not be treated as application. So now these two bars exist. That is application of corpus donations, making of corpus donations to another trust and making of any donation to another trust out of either accumulation or later on deemed application also. In respect of all other applications for which you can actually claim credit when it is in favor of another trust, only 85% will be allowed as the application, subject to whatever your construction is of that circuit. As I have already mentioned earlier, expenditure out of corpus receipts cannot be claimed at all. This results in the amount which you have applied. Income, that is row number 10, minus application, that is row number 25, yields the income which will be brought to tax. The application is the income which will be exempt. Now, you will also have situations where you have either accumulated sums under section 11.2 in earlier years and failed to apply them or otherwise violated section 11.3. Those will be brought to tax in the current year. You may also have cases, similar cases in respect of deemed application under clause 2 to explanation 1 section 11. All those amounts will also be brought to tax in this year. Therefore, the exemption will be quantified as the amount of the current year's application plus this 15%. That is the 15% plus the amount you have actually applied. This is the breakup of that sum. This is broadly the computation of income under sections 11 and 12. I have earlier, before the law was amended to this extent, in some other context, I have prepared a computation with 6 or 7 cases, because on this computation alone there can be 3 or 4 hours of a seminar. But this is a broad strokes, just in case you aren't particularly familiar with it. this has been dealt with. Failure to apply, that is, if you are required to apply 85%, if you do not apply 85% to the extent of 15%, anyway to the extent of 15% you can accumulate without any conditions. Deemed application is Form 9A for 1 year, accumulation is Form 10 for 5 years. I have already dealt with 11.3, which is the circumstances in which accumulation under 11.2 will be brought to tax. There is one important provision here, well it's not so important but it sort of hides in the shadows and sometimes you don't notice it. Subsection 3A of section 11 provides that where you have accumulated sums under section 11.2 and for a particular purpose, and for whatever reason you have not been able to or you are not able to apply the sum for the purpose for which you had accumulated, you can file an application before the assessing officer seeking an order that the purpose be changed. In one case we have done it and we have got an order. It's of course subject to the officer, but it's not a particularly complex procedure. There is no particular form for the application either. It's just been the form of a memorandum. And then they will pass an order and it will be deemed to have been accumulated for the purpose stated. It is also important that the law does not contemplate that you set out any specific purpose. Generality of purpose of accumulation is also permissible. You could also accumulate under section 11.2 for just for the purposes of the trust. Even that is permissible. There is nothing in the law, at least now, which says that the purpose must be specific. The reason the law does not say this is because, as I said, 11.2 is not meant to be a balancing figure. You are supposed to have a purpose in mind and you are supposed to have accumulated it for that purpose. Capital expenditure and depreciation, section 11.6 has been inserted. I believe it is with effect from assessment year 1920, although this is subject to correction. With effect from assessment year 1920, subject to correction, you can only claim depreciation in respect of assets of which you have not taken the capital expenditure application. The Supreme Court in Rajasthan and Gujarati Charitable Foundation has held that this provision is prospective. Therefore, until that point, you could concurrent claims for capex and depreciation were permissible. I mentioned the decision of the Madras High Court in. I'm referring to all this case law in the confidence that Mr. Kota Srinivas is not here. I mentioned the decision of the Madras High Court in Rao Bahadur Kannan Chetty Charities case. This is another judgment where the Supreme Court has quite simply explained the computation of the income of a charitable trust. But again, this is before a few amendments took place. But this is another good source to learn about it. Inter-trust donations, 85% restriction, circular of the board, we have already seen. Illustration of computations is the Excel book that I have already showed you. Treatment of capital gains, again I have dealt with. There is an interesting order of a Chennai bench of the tribunal, in which I apologize, I don't remember the citation, in which it has been held that capital loss can be treated as application of income to charitable purposes. I am not entirely in agreement with due respect with this ruling, but it is there. So there are two classes of claims. The first is a class of claim where you can advise the assessee at the time of making the claim that you can go ahead. The second is post-mortem, where the assessee has already made a claim, you can defend it. So I think this falls in the latter category. A defense of a claim already made can be aggressive. But at the stage of making a claim, aggression is a bad idea. I am not here to increase my professional practice. If aggressive claims are made, my work increases. Exemption when lost. This is section 13. Subsection 1 of section 13 contains a list of circumstances in which you will lose exemption. Section 13(1)(a) deals with private religious purposes. If any portion of your income is applied for private religious purposes, you will not be entitled to exemption. What is a private religious trust versus a public religious trust? I don't want to go into it in depth, but broadly, who has access to the temple? Or who has access to the mosque? There are various family deities, for example, which are private religious trusts. So recently the Supreme Court answered the question of whether the Padmanabha Swami temple in Thiruvananthapuram would be subjected to the charitable and religious endowments law in the state of Kerala. That question was answered in the negative, effectively restoring the control over that temple to the royal family of Travancore, who are the Dharmakartas of that temple. There are various observations there on the question of what is a private religious establishment and what is a public religious establishment. Might not be entirely relevant, but that is, it makes for good reading. Section 13(1)(b) deals with cases where a trust operates for the benefit of a particular religious community or caste. The Madras High Court has held that a linguistic community is not a community for the purposes of Section 13(1)(b), because the word used in 13(1)(b) is religious community. There is a very interesting decision on the Nagpur bench of the tribunal in Bharatiya Utkarsha Mandal, where the tribunal held that the Hindu community cannot be considered a religious community for various reasons. There are decisions in the Supreme Court which hold that Hinduism is not a religion, etc. This is mostly for recreational value. You cannot make such claims in the course of daily life. And in any case, if you are operating for the benefit of a religious community, you might as well constitute yourself as a religious trust and not a charitable trust, in which case these problems do not arise. The exception to this rule is that any income applied in favor of members of the scheduled caste, scheduled tribes and backward classes will not be subjected to this restriction. There is a decision of the Supreme Court in Palghat Shadi Mahal Trust, where it was operating a Kalyana Mandapam, and the question there was whether it is for the benefit of religious community. Again, that is just recommended reading. 13(1)(c) is the most significant amongst these restrictions. It deals, as I said, it is in parimateria with the provisions of Section 40(a)(2)(b), except that the term related person is defined. I think it is called specified person. It is defined in Section 13(3). One of the two subsections, 2 or 3 of Section 13. It includes various persons, including the author of a trust, a trustee or manager of a trust, any person who contributes more than 50,000 rupees to the trust in a previous year, etc. And additionally, any relatives of such person and any concern in which such persons are substantially interested. The term substantial interest is defined here as it is defined for, I think, in 222(e) of the Act in the context of deemed dividend 2, it is defined. Substantial interest means you must hold, in the case of a company, shares equivalent to 20% of the voting power of the company, or in the case of other entities, 20% profit share. Now, there is one exception to this rule. Let us say that the author of a trust holds more than 20% of the equity share capital of a private company, and some portion of the trust's income is applied in procuring services rendered by that private limited company. This would be a violation of it's not a violation of 13(1)(c). You will have to see whether it's reasonable or not. If it is unreasonable, there is a violation. But where that holding of the author of the trust in that company does not exceed 5%, then the restriction does not apply. So these are the broad contours. There is much more to go into this in detail. Then clause D. Clause D deals with cases where the assets of a trust are not held in the mode specified in section 11 subsection 5. So now these are the 4 clauses of section 13(1). Some questions had arisen as to how much of the income would be exempt. If you look at clause A, 13(1)(a) says such part of the income as is applied to private religious purposes will not be exempt. 13(1)(b) said if you are carrying out activity for the benefit of a particular religious community, any income of the trust will be exempt. Therefore, 13(1)(a) applies only to the quantum of the violation. It deprives you of the exemption pro tanto, to the extent of the violation. 13(1)(b) will deprive you of exemption in toto for the whole of your income. 13(1)(c) and D are also phrased, the plain words of the statute state that any income of the trust will lose exemption. Therefore, if there are various extremely large, professionally managed, corporatized non-profit organizations today, in which CEOs are often paid salaries to the tune of, say, a couple of crores a year. In these circumstances, if the total application of the trust is, say, 50 or 100 crores in a year, and the managerial remuneration to the CEO is stated to be unreasonable to the extent of 50 lakhs. For the violation of that 50 lakh, I will lose exemption for the whole of the income. These were the words of the statute earlier. But this was per se unreasonable, and therefore various high courts, despite these words, various high courts held that only that part of the income which is violated 13(1)(c) would lose exemption. The similar issue arose in the context of clause D2. In that context too, the High Court judgments are pretty much along the same lines. Rather, you can follow one for the other. Now the law has been amended. There was also a CBDT circular and all that. But anyway, now the law has been amended to say that only that part of the income will be exempt. So now there is no longer any controversy. For any of the clauses of subsection 1 or section 13, the exemption will be lost to the extent of the violation of that clause. This is so far as section 13(1) is concerned.
Sir,
Yes, sir.
there are, nowadays also you see a lot of trusts exclusively for particular religion and all, but the trusts, they are not having this body or what?
They might be religious.
They may register as religious.
Yes. So, that benefit to a particular religious community you are not allowed to do if you are a charitable trust. If you are registered as a religious trust, then you can do that, but you will not be indebted to ATG.
For like TTD, what do you mean?
I'm sorry.
For a exemption can be registered.
Yes, yes. Yes, ma'am.
Elaborate on anonymous donations.
I'm coming. Yes, ma'am.
So, with regard to the previous slide where you were mentioning about the capital expenditures. So now, is there any conditions to which what constitute your capital expenditure? As in, if you buy a land or something like that, you have to directly. I mean, is there an onus of proving that it is towards your charitable activity?
You are asking in the context of whether it will be treated as capital expenditure or
Then
application.
you will get the benefits of application.
Accounting principles, ma'am. Whatever there is no.
So if they buy a land as an investment, even that.
You can treat it as capital. You have to follow what. So all these questions on capital and revenue, whether in charitable trusts or in business income, are answered only on accounting principles.
So then be asking whether the capital expenditure also should be for the objects of the trust.
Yeah,
That's what
As
I think that's the question.
yeah.
It is very hard. So it is very hard to say that. So remember that what is you are exempt because your object is charitable, not because your activity is charitable. It is very hard to say that you will ever buy an asset which is not for charitable purposes. If you do that, you will be in breach of trust because you are violating a trust deed. So, additionally, so I don't think that confusion needs to arise. Any asset you buy will be for charitable purposes. This is further sanctified by the position that subsection 5 of section 11 restricts what you can invest in anyway. So it's not as if you are going to do some innovative, for example, shares in a private limited company, you cannot hold. So I don't think a situation will arise where it is not for the purposes of the charitable trust. Nevertheless, I want to answer the question that you did not ask, which is how do you determine whether a particular item of application of income is attributable to capital or revenue? As I was just saying, the tests are tests of accounting principle. The tests are the same as they are under the head business or profession to determine whether it is 37(1) or 32. And for that, this is a judgment I recommend reading the most. HED Consultancy Services, which I referred to earlier, HEDE Consultancy Services. Panditji bench of the Bombay High Court, Justice V.C. Dava's judgment. Outstanding exposition of principles on how to determine what is capital or revenue. As it is a, so it is a lesson in accounting. It is not a lesson in law on the distinction between capital and revenue. I think it would not be inappropriate for me to point out that I was told that before Justice Dava started sitting in the bench which heard tax matters, he had never dealt with a single tax matter in his life. And somebody who appeared before him, he's long retired now, I think he retired in 2011 or 12. Somebody who appeared before him told me that it took him only 6 months to pick up the tax law and understand it fully. And then you see judgments like this, which are just very beautiful. I practice the law only for that beauty. Anonymous donations. So anonymous donations I would have dealt with later in the context of section 115 BBC, but it is dealt with also by section 13. The reason, so the law on anonymous donations is this. Anonymous donations will be taxed at the rate of 30, at the maximum marginal rate, at the rate of 30% under section 115 BBC. You will not, and had that provision been there, and had the amendment to section 13 not taken place, then you could have said that I would have applied out of that anonymous donation and claimed application. But anonymous, that you cannot do. 115 BBC also says that no deduction or allowance can be claimed under any other provision of the Act. So you cannot even treat it as a receipt under section 56 and claim 57 deductions. Essentially, gross anonymous donations will be brought to tax. That is clear. The question is, what is an anonymous donation? Section 115 BBC says that a donation is anonymous if it does not, if the recipient organization does not maintain with it particulars of the name, address and such other particulars as may be prescribed in respect of the donor of that donation. To the best of my knowledge, there has been no prescription in the sense that name and address is there in the law, but there has been no rule framed or notification or anything promulgated so as to list any other particulars. And my suspicion is that there should not be any other particulars also, because you cannot insist on PAN, Aadhaar, etc. from smaller donors. So the law now is, if you have name and address, it will not constitute an anonymous donation. The question then is, can I just put a name and address against every donation? You can't, because if you are granting the benefit of ATG, then there is a limit up to which you can accept donations in cash. And if you are accepting by bank transfer, the identity of the donor is fairly easily established. And secondly, this is why assessment proceedings exist. The Income Tax Department will send an inspector to the, what should he do? He should issue either notices under 133(6), or he should send an inspector to 5 of the addresses mentioned in the thing, and it is fairly easy to figure out. In fact, I suspect that he will do this, and even where they are genuine, he will say that I did not. What is happening in many cases in assessments these days. For example, since section 68 and 69 ABC are the favorite provisions of the department because of 115 BBE, in all cases where there is any money credited into your bank account, they will issue 133(6) notices. They will issue the notice only about 20 days before the period of limitation expires. They will give 5 days for that noticee to respond. The noticee will not even have realized that the notice has come, and he will not respond. The assessing officer will issue a show cause notice, and you can address the arguments, he will not accept, and he will add it back. Then you will, in some cases, in large cases, you will go to the High Court and the order will get stayed. This process is, rinse and repeat. It has been happening in a number of cases. A similar thing can happen here too. Any other question on anonymous donation?
What happens in case of a religious trust?
Section 115 BBC doesn't apply to religious trusts.
Okay, so religious trust can have n number of anonymous donations.
Yes.
Alright.
Yes.
So all my temple trusts will get covered there.
Yes.
So it's okay even if they do not maintain any kind of register for any amount. Even if it's a bank transfer, I have skipped.
I knew you were asking this question when you began. So, since we are talking about charitable trust, the law has always been very charitable to religion and politics. Section 13A exists in a silo of its own. for political parties. So the question being posed is, if religious trusts are not subject to anonymous donation, can the trust just not maintain records for any donors? The answer is yes and no. Theoretically you can. You will not be subject to tax under this. But you can never restrict the power of the assessing officer to conduct an inquiry. And so these kinds of questions often come from chartered accountants who have not studied the Code of Civil Procedure and the Indian Evidence Act. And I think that should be a part of the curriculum to some extent. Not that our curriculum is not big enough anyway. So in tax proceedings are civil proceedings. Although the tax law is not strictly either civil or criminal, tax proceedings are civil proceedings. In civil proceedings, the standard of proof is preponderance of probability. Therefore, what a judge or officer should do, he should take all the facts which suggest that a fact exists, all the evidence which suggests that a fact exists, all the evidence which suggests that the fact does not exist, and put them on a weighing scale. Whichever side the scale tilts, that is the conclusion. So, the Evidence Act, please read section 3 of the Evidence Act. It beautifully defines the terms proved, disproved and not proved. A fact is said to be proved. I am stating this from memory. I can assure you I am wrong, but you will condone my incorrect statement. A fact is said to be proved where any reasonable person will say that it is more likely, more probable that it occurred, that it exists than that it did not exist. This is the test of preponderance of probability, which we know in accounting standards reasonable certainty. Anything more than 50%, it is the same test. If I am today before an assessing officer as a religious trust, saying that I am not maintaining records of any donations, he will ask the question that he will first issue a 14821, at least he ought to. He will first issue a 14821 and say, what are these donations? You say, I don't have records. Then he knows that he cannot tax it on 115 BBC. Why is it not an unexplained cash credit? Why is it not any of those other provisions under section 69? And let us assume that 68, 69, all those provisions did not exist. Let us say that you are a large religious trust which is closely associated with a politician. That politician has been found in the possession of assets disproportionate to the known sources of his income in cash. Is the question in this case whether the preponderance of probability is that these amounts which are discovered to be in your possession are in fact his. So then the probabilities will have to be weighed and the evidence will have to be weighed. So to suggest that the absence of a requirement in the law to do something frees me from the requirement to do that thing in general is a little rash. So that's why I said the answer is yes and no. And we must all remember this test of preponderance of probability. A lot of assessments go wrong because the submissions are not all right. Somebody asks, you have claimed, the assessing officer issues a notice under 142.1. Actually, this should be a separate seminar on assessment. Assessing officer issues a notice under section 142.1 saying that these amounts have been credited to your bank account. Please establish their genuineness. You will say the bank statement says that it is not cash deposit, it refers to a UTR number, therefore it is genuine. Has this passed a test of preponderance of probability? The answer is no. It only shows it has come from some other bank account. So who is the identity of that person? Why did you receive that amount? How did you treat it in the books of account? Is there any service rendered in that context? So the whole of the transaction has to be appreciated in its totality to establish that the evidence proves what you claim to be the fact. You must also, in dealing with assessments, appreciate the helplessness of the position of the assessing officer. He only has papers. He has no idea whether it's all a sham in its entirety. So you have to go the extra yard to ensure that he is satisfied. Okay, I will stop with that, otherwise that tangent is too long to go down. But all this has become significantly more relevant after the faceless proceedings have come into play. And faceless proceedings therefore are a significant opportunity for us because it is no longer a negotiation. that I will tax this and I will not tax that. It is now an actual assessment. There will still be perverse orders, there will still be wrong orders, there will still be cases where the submissions are not good, but at least the rules of the game are a little narrower. And I can tell you that in our practice we have had cases where an addition of 100 crores has been proposed in the show cause notice under 144B, and ultimately the addition was not made in the order because of submission advance. Things happen, bad assessment orders are passed, good orders are passed. Anonymous donation, trade, commerce and business. Trade, commerce and business I have dealt with. 11 2 delays. Anyway, that also I have dealt with. Who are related persons I have dealt with, what is benefit I have dealt with. Subsection 3 of section 13 lists a series of transactions which will be deemed to be transactions within the meaning of section 13(1)(c). So please read subsection 3. Now taxation when exemption is lost, who is the assessee? This is a very interesting question. I will go only a little bit off topic, but I think it is relevant. There are broadly three kinds of entities which are registered as charitable trusts. The first is a Section 8 company. By virtue of the provisions of the Companies Act, the Section 8 company has corporate personality independent of its shareholders. Therefore, it is a person. The second is a society. Whether a society is a person would depend on the structure of the Societies Registration Act of the relevant state or the Indian Societies Registration Act where a state enactment does not exist. Broadly, let us just assume that societies are, more often than not, they are persons. What then is a trust? This is a concept that most practitioners unfortunately do not understand, and this is for various reasons. It is incorrect to presume that all law is statutory law. The law extends far beyond that which has been passed by Parliament or the state legislature into what is known as the common law and what is known as the English common law. The English common law continues to apply in India to the extent that it has not been modified by subsequent statutory law. To give you an example, let us say that tomorrow the Sale of Goods Act is repealed. Can you therefore say that no sales of goods can be made? Or another example, say the Indian Contract Act was never enacted. There was a long period of time in England where there was no statute on contracts. Is that to say therefore that contracts until the law came into force were not enforceable? The answer is no. The broad principle is a citizen or a person can do anything which the law does not prohibit, whereas the state can do only such things which the law permits. Therefore, if there is no law prohibiting the entry into a contract, you can certainly enter into a contract. Let me give you a curious case of this from Indian constitutional history. In Article 21 of the Constitution of India says that no person shall be deprived of his life or personal liberty except in accordance with procedure established by law. In the course of an emergency, as the Constitution stood when the emergency was declared, fundamental rights stand suspended. Constitution bench of the Honorable Supreme Court in ADM Jabalpur vs Shivkant Shukla by a majority of 4-1 held that since in an emergency the fundamental rights stood suspended, Article 21 was the sole fount of the fundamental right to life and no person had a right to life in an emergency. This was the reasoning of the Supreme Court. Now, is this a reasonable construction? The answer is no. So to understand what a trust is, we can certainly read the Indian Trusts Act, but section 1 of the Indian Trusts Act states that it does not apply to public, charitable or religious endowments. At least 2 high courts have therefore held that the Indian Trusts Act does not apply to charitable trusts. There is a problem. So I made this point just yesterday at Chikmagalur for the Udupi branch, and somebody asked me in the return form, under which law am I registered? There is a question. And in that, if I am a charitable trust and the trust act doesn't apply to me, what do I put? I don't know the answer to that question because the form is a law unto itself. So please comply with that law for the satisfaction of the form, and the real law we will deal with here. So Indian Trust Act doesn't apply. What does the Indian Trust Act do? It codifies and modifies the common law relating to trusts. So what is the common law of trusts? Salmon on jurisprudence is Salmon and Jurisprudence is a book all of us should own. If you want to know, if you wake up one morning and have this question, something is wrong with you. But if you're working on something and you suddenly have a very fundamental question is whether this entity is a person or not, whether I in fact own this property or somebody else owns this property, what is the nature of my right? These kind of fundamental first principles of the law are addressed in Salmon and Jurisprudence. The subject of trusts is dealt with under the chapter ownership. A trust is a form of ownership. Let us assume that I am an individual. I don't think that requires assumption. I am an individual. I purchase immovable property. Somebody else unlawfully takes possession of that immovable property. So that person has to be sued so that I can secure possession. So I file a suit for possession. Who will file the suit? I will file the suit because I am the owner of the property. Why will I file the suit? Because I am the legal owner of the property. In law, you are either person or property. There is nothing else. If you are a person, you have the right of ownership. If you are a property, you are the subject matter of ownership. So everything else, rights, obligations, etc., relations between persons inter se or persons and property or property inter. Property inter se, there is no relationship. So I have to sue because I am the only person who is in charge of that property, therefore I am its legal owner. I succeed in the suit. I thereafter let out the property and earn rent. I am entitled to earn that rent. That is because I am entitled to the benefits of that property being its owner. So there are two kinds of ownership, legal ownership and beneficial ownership. Salmon says a trust is a curious kind of dual ownership where the legal ownership and the beneficial ownership vest in two different people. This is all a trust is. The trustee is the legal owner of the property, the beneficiary is the beneficial owner of the property. So now I am coming to who is the assessor. So if you look at all decisions of the Supreme Court and High Courts before the 70s or 80s when people forgot these principles, you will always say that the name of the decision is not locus sectional trust. It is sole trustee locus sectional trust. Because locus sectional trust does not exist as a person to present a petition before a court. Now the GST law gets over this difficulty by defining the term person in section 2 to include trust. But if you see section 231 of the Income Tax Act, it does not include trust. It only includes in the residual limb artificial or juridical person. There is nothing in the law to render a trust a juridical person. So who is the assessee when a trust loses an exemption? The trustee is the assessee. When a charitable trust loses the exemption. For this, we must go back to section 164, which deals with representative assessees. You might already be familiar that in the context of private trusts, there are two kinds of trusts. There are discretionary trusts and trusts which are not discretionary trusts. I will call them specific trusts, so that nomenclature is not very accurate. A discretionary trust is a trust in which the shares of the beneficiaries are unknown. If there are 5 beneficiaries of the trust, there is one trustee who is a legal owner, and he has discretion, for example, to say that A will get this much, B will get this much, C will get this much. That is a discretionary trust. In the case of a discretionary trust, the Income Tax Act cannot assess the trustee, cannot assess the beneficiary, because if the income has not reached the beneficiary yet, and the income tax law does not know which beneficiary earns which income or how much income, because the shares are unknown. It cannot tax the beneficiary. So 164 says that in the case of a discretionary trust, the trustee will be taxed. But in the case of a trust which is not discretionary, the taxation can be either on the trustee or the beneficiary. In the case of a charitable trust, the beneficiary itself is unknown. It is an unknown body of people. Therefore, where exemption is lost, the trustee will be taxed. Now, what is this? Now, considering that a trust is not a person under section 231, what is the status of a trust? Will it be taxed as an individual, a company, an association of persons, a body of individuals, a firm, etc.? The status of a trust is defined by the status of the beneficiary. In the case of a public, charitable, or religious trust, the beneficiaries are the public at large or some substantial portion of the public. This is considered to be an association of persons. It is for this reason that the rates applicable to AOPs will apply to a charitable trust in the event that you lose exemption. The trustees will be taxed as representative assessees under section 154. You know how much we have forgotten this law? At this point, PAN is issued in whose name? Trustee's name or trust's name? Fundamentally, that is incorrect. Assessment in the name of Supreme Court judgments are there. Assessment in the name of a wrong person is fatal. So if I am assessed in the name of the trust, is that not automatically fatal? Theoretically, yes, but there is a principle called stare decisis, which says that even if the law has been misunderstood for long enough, that misunderstanding is the correct law. Otherwise, there will be disorder, there will be chaos. Yeah. Now on the question of registration. Until the insertion of Section 12AB, Section 12AA applied, and until sometime in 1996, if I remember correctly, Section 12AA did not apply, Section 12A itself applied. Now, until 12AB came into force, registration was a one-time affair.
Sir,
Yes, sir.
which act applicable to public charitable trust? If it is not private,
No act. There is no law in government public trust. Common law. In certain states, there are some laws under which you are required to be registered. In the states of Maharashtra and Goa, there is a Bombay Public Charities Act under which you have to register. Similar law exists in Andhra Pradesh. But in Karnataka, Tamil Nadu, Kerala, there is no such law. This is the point I am trying to make. There need not be an act for everything. A trust simply exists because the English common laws existed, and we have inherited the English common law. There is a provision in the Constitution, Article 370 something, 372 or something, which says that unless, so all laws existing before the commencement of the Constitution will continue to exist unless they are contradictory to the Constitution. This is how all the acts which were enacted pre-Constitution still apply today. Sale of Goods Act, Partnership Act, Contract Act, Transfer Property Act, Trusts Act. So there is no law there is no enactment which governs charitable trusts. Let us understand why. Charitable trusts were trusts, not charitable trusts, trusts in general, were a concept which the British evolved much before the enactments came into force. Can you say the same thing about company? If there is no Companies Act and 7 of us get together, execute a memorandum of association, articles of association, there is no registrar to register it, but registration is a procedural requirement. Can you say that when we create that MOA and AOA, that automatically the group of us will attain separate legal personality? No. The law has to say that. Therefore, a company can only be under the Companies Act. And there can be no company without the Companies Act. But you cannot say the same thing of a contract or of a partnership or of a sale of goods or of a trust. Forget about this. I sell you immovable property under the registered sale. Under which act am I selling it to you? Transfer of Property Act. If the Transfer of Property Act, until the Transfer of Property Act was enacted, no sale is valid. So it's the same logic.
So the Indian trust type is catered to
Private trusts. The Indian Trust Act applies to private trusts, where the beneficiaries are known and identifiable. It is not the charitable trusts. Section 1 says it. And in fact, if you read the Indian Trust Act now, the modes of investment specified in that act are much more restricted than Section 11(5). It is never the intention of that act. If that act applied, then you will have to comply with all those requirements, which is not possible. The act does not apply to charitable trusts. So when everybody puts up a board saying registered charitable trust, it means registered under 12A. There is no law under which you register it. What you register in the case of the trust is a trust deed. That is a registration of a document, not the registration of a trust. Because a trust is not a thing which can be registered. It is an event. It's not even an event. It is a phenomenon. You can, so that registration of the title deed, of the trust deed, is under the Indian Registration Act 1928. Yeah, this, I can go on this tangent for a few hours, let us not, it is very interesting, but we have a syllabus. So, now registration under Section 12AB. So, until the introduction of Section 12AB, registration was a one-time affair. You were registered once and you would remain registered until registration was cancelled. There is an interesting order of the Mumbai bench of the tribunal in one of the Tata Trusts groups, where the harassment of the income tax authorities of charitable trusts is well known. Tata Sons Limited which is the ultimate holding company of the Tata Group, most of the shares in the group are held by a charitable trust. Now, that trust was registered under 12AA and it was claiming exemption under sections 11 and 12. At one point, the assessments and appeals and all that became so many that the trust decided, listen, we don't want exemption, we will just pay tax. So they wrote a letter to the commissioner saying that, please, we are surrendering our registration under section 12AA. What will the commissioner do? He will do nothing. Because if he rejects it, then the trust can challenge it. If he accepts it, then he loses some rights. So he did nothing. When 115 TDTF on accredited income were introduced, at that point he cancelled the registration. He said, in response to your application, I am cancelling the registration now. And then he levied a tax under section 115 TD. Obviously, the tribunal said that this is complete nonsense. So, registration was a one-time affair until cancelled. The reasoning in that order is significant, which is that no assessee can be forced to claim a benefit that they do not seek to claim. So, even if there is no express statutory provision saying that you can surrender registration, if you have the benefit, you have a right to surrender it. But this rule is also not without exceptions. For example, section 32 on depreciation says that depreciation shall be claimed. So you don't have the option not to claim depreciation when you compute business income. With the insertion of section 12AB, registration is no longer a one-time affair. A new trust will be provisionally registered for a period of 3 years. Upon the completion of the 3-year period, you will get a registration. For the sake of simplicity, I will call it final registration, but there is no word final in the law. That final registration is for a period of 5 years. So a new trust will first have to get provisional registration for 3 years and then final registration every 5 years. The position is the same in respect of approval under section 80G. Existing trusts who are in existence before the commencement of section 12AB will get final registration of 5 years with effect from the date of commencement of section 12AB upon filing an application. Therefore, there are various situations in which you may have to file an application. You could be an existing trust filing an application directly for final registration. You could be a new trust filing application for provisional registration for the first time. You could be a trust who has served the period of provisional registration and is seeking final registration, etc. All of these cases are dealt with in this table. The first case, the application is made under clause AC of subsection 1 of section 12A. Each of the subclauses deal with various cases. The first case is where a trust was registered earlier. You ought to have filed the application before the 1st of July 2021. This date, as usual, everybody filed belatedly their application for continuation. They issued multiple circulars extending notifications, extending the date to some extent. Now, I think circular number 7/2024 dated 25th of April 2024 extends this due date up to 30th June 2024. Now, let us say I am a trust registered earlier. I am a trust registered earlier, which means that when my registration was originally granted, the commissioner would have examined my trust deed and my other factors to determine whether I am entitled to registration. Therefore, at this stage, there is no need to once again examine all those factors. Therefore, where you are registered earlier and you file an application under subclause 1, the commissioner has no power to conduct inquiry or reject the application. He must grant the registration. This is what the law provides. He has to pass this order within 3 months from the month in which he received the application. The registration will be in continuous effect from when you originally obtained it. Next is where you are provisionally registered. That is, you have already filed an application for provisional registration. You have secured provisional registration. Now you want to secure final registration at the time of expiry of the provisional registration. You have to file this application at the earlier of 6 months before the expiry of the period of limitation, a period of the provisional registration,
or 6 months after the activities commence, whichever is earlier. This is for one reason. Let us look at the last two line items in the table. There are two situations where you will seek provisional registration. This is, in both situations, you are a new trust seeking registration for the first time. You may have commenced activities and then you may be seeking registration, or your activities may not have commenced at all. If your activities have not commenced, then you have to file the application 1 month before the previous year for which you seek registration. This is a bit of a problem because we are now in May 2024, and if I file an application now, I will get registration only with effect from previous year 25-26 assessment year 26-27. This is something you should be conscious of. So if you are a new case, you have to file 1 month before the previous year for which you seek registration. In this situation, since your activities have not commenced, the commissioner has no power to conduct any inquiry or reject, he simply has to accept. This I think is problematic. The commissioner has to have the power to examine the trustee to determine whether you are a charitable trust or not. The law doesn't really confer that power upon him, but if the matter gets challenged in court, they will say that he is permitted to do it. But please correct me if I'm wrong. I understand that these applications are now processed electronically. So if you file the application for provisional registration, you attach the relevant documents, you just get the provisional registration. So for 3 years, you essentially get the benefit of exemption, even if you don't strictly comply with the various conditions which you are supposed to comply with. Then, if you are a new case but your activities have commenced, you can file an application any time after the commencement of your activities. This is for obvious reasons. Let us say I am a charitable trust in operation from 1980 and I have never chosen to claim exemption under section 1112. I can now file an application and seek registration to claim exemption. But in this case, since activities have already commenced, the commissioner has the power to inquire into the matter and determine whether to grant registration or not. This brings us back to the second line item where you are provisionally registered and seeking final registration. You have to file the application for final registration at the earlier of 6 months before the expiry of the provisional registration or 6 months after the activities commence, whichever is earlier. This is the relevance of the commencement of the activities we have now understood. Then the commissioner can inquire and choose whether to grant registration or not. The remaining cases are fairly easy. Where you are finally registered, you have to file the application 6 months before the expiry of your final registration. Where 11.7 is a case where you have to pick between approval under section 1023C or registration under section 1280. You can't do both. May not be relevant, I won't do it. The next is a situation where you modify the objects. See, earlier under 12AA and under 12A, whenever the objects in the trust deed were modified, you would simply furnish a copy of the trust deed to the commissioner, essentially as a matter of courtesy because the law did not require it, but the commissioner was granted registration on the basis of some objects. So it would be his right to know whether you are still carrying on activities in that manner. In fact, we would do that in any situation that you amended the trust deed, whether that amendment was to the objects or otherwise. Now, the law itself requires that when you modify your objects, you have to file an application for registration once again. That is so far as registration, application for registration.
Sir,
Yes, ma'am.
is 07/2024 applicable for all first two cases or only for the first case circular? The
I'll show you, sir.
extended due date.
It is applicable for the first two cases, clause 1 and clause 3.
Yeah.
I'll just show you the circular, just to ensure that I'm remembering it correctly. In case of application under subclause 1 of clause AC of subsection 1 of 12A or subclause 3 of clause AC of subsection 1.
It applies to clause 3.
So provisional registration, when you want final registration after provisional registration, the circular extends. Or when you are an existing trust registered under the old regime, the circular extends. Only for these two cases.
Only for these two cases.
Yeah.
Like I have missed applying for final registration.
When you have provisional.
Yeah. So that due date, extended due date applies to me.
Yes. If you think about it, there is no other case for which there could be a delay now, because 5 years have not elapsed since the commencement of the section. So your final registration, if any, could not have expired already for you to file an application. So at present, only 2 forms of application require this delay confirmation.
When we are applying for renewal, they are telling you already have a 3 years time, you can apply again, come into last 6 months there.
Yeah, there is a problem there. Let us go to the section.
They are deeming this is as final registration.
They are deeming
it, they are not getting provisional registration. They are treating same as final registration.
No. So there is a different issue here. For existing trusts who are registered under the old regime under 12AA or 12A, you are entitled to registration for a period of 5 years, not for a period of 3 years. All those registration orders which were passed when the applications were filed in 2021 wrongly stated that you are provisionally registered. CBDT then issued a circular saying that in all those cases wherever we said that it is provisional registration, it is not provisional registration, it is just final registration. So therefore a registration is for a period of 5 years. In that situation, you don't have to go within 6 months before 3 years. That is the reason. But there is another problem there, because where the trust or institution is registered under section 12AB, this is final registration, and the period of such registration is due to expire at least 6 months. At least 6 months prior to the expiry of the said period. That means there is nothing that prevents me from going on day 1 of my final registration applying for the next final registration. I cannot come less than within 6 months of that date. So even that argument of theirs is wrong. But nobody thought about this when drafting the law.
There is no need to inform if management committee changes.
Only under FCRA, not under income tax. More than under FCRA, I think if there is more than 50% of change in the managing committee, some form is to be filed. Unless, of course, the trust deed has to be amended for that purpose. If the trust deed says that trustees can be appointed by election, etc., then there is no problem. There are some trust deeds which say that this person will be a trustee for life. If you are amending the trust deed, then you may have to inform the commissioner. There is another problem here. Earlier we used to intimate the commissioner for any amendment of the trust deed. Now it says, the section says that only when you modify the objects you have to file an application. But there is in the registration, so the question is, if I modify something in the trust deed other than the objects, do I have to file an application? Strictly speaking, no, because the section doesn't say it. But the registration certificate or order by which registration is granted, these days impose a list of conditions. And you have to see whether those conditions are complied. There is an order of the Bombay Tribunal saying that the commissioner does not have the power to impose conditions. But after that, the law has been amended not for this purpose but for something else. And by mistake, I think they conferred this power also. But there is some confusion there. So, in all this confusion, the simple solution is where you undertake any amendment to your trust deed, please intimate the commissioner and please comply with the conditions stated in the order or certificate of registration. Where you change the managing committee and that is not occasioned by any amendment to the trust deed, there is no need. But that also please check if there is any condition mentioned in the certificate of registration. Then in that email you have to record that you were told by the commissioner's office that it would suffice for the purpose to inform you by email. You have to ensure that everything they say is put in writing. This is how assessment proceedings also have to be done. There should be a reference with every earlier response and notice so that you cannot deny that you did not do something. Now, so we have dealt with all this. Now on the question of cancellation. I have about 20 more minutes. I will take those 20 minutes. Earlier, the number of grounds on which registration could be cancelled was very limited. If your activities were not in accordance with your objects, or if your activities were not genuine. This genuineness is a very subjective test, so now commissioners say everything which they don't like is not genuine. So somebody has to lay down the law on what genuineness constitutes. Now the entire dispensation is very different, because the basis on which you can cancel registration under section 12AB is not merely genuineness, it is a list of events which are all called as specified violations. Section 12AB contains an explanation in which the term specified violation is defined. Specified violation is therefore an essential ingredient for the cancellation of registration under section 12A. There are 8 specified violations. The first is where any part of the income of the trust is not applied for its objects. The second, this I think is unduly harsh. Anyway, you are denying exemption, why would you also cancel registration? Second is, section 11(4) says that a trust may carry out a business, but it must maintain separate books of account and the business must be incidental to the objects. If you are carrying out a business and you are not meeting those 2 conditions, that is also a specified violation. Third, there is any private religious purpose, that is, there is some religious purpose which is not inuring for the benefit of the public, that is also a specified violation. Fourth, you have applied any income for the benefit of a particular religious community or caste. So you will start seeing similarities between section 13(1) and specified violations in 12. Fourth is your activities are not genuine. Fifth, your activities are not carried out as per the conditions of registration. So there is no provision which empowers the commissioner to actually grant registration subject to conditions. So the question is whether the word conditions here refers to some statutory conditions, or whether this phrase must be construed as indirectly conferring upon the commissioner power to impose conditions. That is subject to interpretation. The seventh is any other law which is relevant to the activities of the trust has been violated, that would also be a specified violation. To give you an example, if you are an educational institution and you violate the Capitation Fees Act, then that would result in the cancellation of your registration. Finally, if you file an application for registration under section 12A subsection 1 clause AC, and any particulars in that application are either false or incorrect or incomplete, I think this is very harsh. If there are false particulars, that is, if you are able to establish that the applicant was knowingly making false statement in the application, there is a justification in cancelling registration. But if it is merely incomplete or incorrect, I don't see the point in cancelling. But you will also note that if the application is incomplete, false or incorrect, and they want to cancel registration for that, it means they are admitting that they have been incompetent at the time of granting the registration. If the application was deficient, they ought not have granted the registration in the first place. These are the specified violations. Now, what happens if there is a specified violation? A specified violation from the list that we have just seen could occur in this year, or it could have occurred in an earlier year. What are the powers to cancel in this respect? There are 3 manners in which the specified violations may be invoked to cancel registration. The first is, the commissioner may notice the occurrence of a specified violation during any financial year. In that case, he may cancel registration from that previous year and for all subsequent previous years. My contention is that this word during means that the commissioner, the act of noticing a specified violation must be during a previous year. Therefore, he can only notice a violation in the year in which it occurred. My contention, therefore, is where the commissioner has to notice the occurrence of a specified violation during a previous year, the word during qualifies the act of noticing and not the occurrence of the specified violation. So my contention is, if a specified violation has occurred in the financial year 21-22, The commissioner cannot notice its occurrence now and thereby cancel registration. He ought to have noticed it then. What then is the remedy for the department where a specified violation has occurred in an earlier previous year? In that case, in the course of assessment proceedings, the assessing officer can refer the matter to the commissioner saying that a specified violation appears to have occurred. You may choose to cancel the registration. Sir? So, you may. So, where a specified violation has occurred in an earlier year, the AO may point it out in the course of scrutiny proceedings, and thereupon the matter will be referred to the commissioner will cancel registration. You will note that in both these provisions, the registration can be cancelled for that previous year in which the specified violation occurred and for all subsequent previous years. Therefore, conceivably, registration can now be cancelled retrospectively, because if hypothetically reassessment proceedings are initiated in 2029-30 for assessment year 2023-24, and in those reassessment proceedings the assessing officer notices a specified violation, registration can be cancelled from assessment year 23-24. So, retrospective cancellation is possible, but my contention, and this is subject to judicial consideration, is that when the commissioner initiates the proceeding, he can only be cancelled from the year in which he has noticed the specified violation. There is also a third scenario where the case may be selected for cancellation on the basis of the risk management strategy of the board. Practically, I have not seen that scenario occurring. Next, we come to application of income. Basics: no distinction between capital and revenue, repayment of loan, inter-trust donations, depreciation and capital expenditure, disallowances. All this we have already dealt with. ICDS applicability. ICDS has been prescribed under section 145 capital A, which applies to income under the head business and profession and also income from other sources. If a trust loses its exemption, its income will be brought to tax under section 56. Therefore, if you follow the accrual system of accounting, ICDS could apply to you. This is another reason to follow cash basis and not to follow accrual basis. Next, we come to accreted income. This is a provision which has caused quite some controversy, as it is being interpreted as being extremely anti-assessing. I respectfully disagree with that view. The provision, the philosophy of the provision is this: if you are a charitable or religious trust, and at some point you cease to be so, that is, either you deprive yourself of the right to be registered under 12AB, or you convert into a non-charitable organization. Say you surrender your license under section 8 of the Companies Act. Then all the income for which you have enjoyed exemption in all these years, now we will bring to tax. This is the principle, this is the broad policy behind the provisions of section 115 TD, TE and TF. Now, how does the mechanism of this charge work? Effectively, what is being taxed is net assets which have enjoyed exemption. Therefore, you consider all the assets which have been acquired out of exempt income, reduce from there all the liabilities, and then the remaining, the net figure is treated as your accreted income on which you have to pay tax at the rate of either 30% or taxes payable at the maximum marginal rate. Now, how then do you, more precisely, how do you compute the accreted income? Each of the assets is to be computed at its fair market value, that is, and that is prescribed by Rule 17CB of the income tax rules. For most assets, the value of the asset is a fair market value. In the case of immovable property, it is the higher of the fair market value and the stamp duty value. So this is something you should be able to establish tomorrow. It is better to get a valuation report to ensure you are protected. Liabilities, of course, there is no question of valuation. Now, in what circumstances does the levy of accreted income tax arise? First, there are three circumstances. First is where you are converted into a form in which you are not eligible for registration under section 12A. This conversion could be either because your registration was cancelled or because you modified your objects in a manner not in conformity with sections 12AB and 1023C, or because you did not file an application for registration within the period prescribed. The second ingredient is where you merge with an entity other than an entity registered under section 12AB or 1023C with similar objects. And the third is where you dissolve, but you do not transfer your assets to an entity with similar objects registered under 12AB or 1023C. The levy will arise as on the date of this event resulting in the taxation, and the tax is payable within 14 days of certain other dates which are set out in the section. Then after that 115TE deals with interest and 115TF deals with the declaration of an assessee in default for non-payment of tax. These provisions are somewhat in pari materia of subsections 1 and 1A of section 201 dealing with TDS. Broadly the same principles apply. The only other relevant point on accreted income tax is that the tax can be collected both from the trustee and from the trust. This in my view is extremely harsh, and in my view it merits amendment. Anonymous donations I have already dealt with. With that I come to the end of today's session. I thank you for your patient hearing. I don't have to, with judges also I expect patient hearings. With audience, they are more at my mercy. So it is not easy for me to say that a patient hearing means a good hearing. Therefore, I will courageously presume that this seminar has added value to you. I am open to taking any questions, and my thanks to the Bangalore branch once again. Yes.
Regarding cancellation.
Yes.
Cancellation, if the auditor is not submitted some form 10B and 10BB, some relating to audit.
No, that will not.
That same also they can cancel the registration.
No, sir. There is no provision for cancellation of registration. You will lose exemption. You will not lose registration. Yes, sir.
In case of cancellations, you can still reopen the assessments which are closed and the time limit has expired.
Yeah, so I am presently in the tribunal and in the High Court, because I am in the tribunal against the cancellation order under 12AB and in the High Court against all the reassessments for all the early years. The statute does not provide a mechanism to prevent the officer from reopening assessments for all the retrospective years for which the registration has been cancelled. There is no mechanism in the statute to prevent this. There is a problem. The question then is, let us say I pay accredited income tax, and then the tax is levied in the reassessment provisions on that, then you end up paying tax twice.
I would still pay it up to 90.
Yeah, because if in the reassessment, he will say that registration has been cancelled, deny exemption and levy tax. And then in the cancellation, you have to pay accredited income tax. Effectively, the same income is being taxed twice. So there is a problem here. There is actually a constitutional problem here. But we are examining. I am in the High Court. We have taken these grounds. But if we can win on some shorter point, we will. Yes. A cooperative society is not subject to the provisions of Section 12. I am not answering questions on 83, sir. Yes, sir.
Sir, just the meaning of corpus. Does it come with specific direction of its how it should be used?
How it should be used, there is no need for a direction that a corpus should or should not be used in one way or another. It is that it should go to corpus. There is a need for a definition in the statute. I would not say that. But the thing is, in accounting parlance, we understand what a corpus is. That is all. There is nothing beyond.
No, if I have deficit.
Right. There is a decision of the tribunal in a 1985 order called Dharma Pratishtana, in which the question posed was whether you can utilize funds out of corpus or not. The tribunal said it very beautifully. They said that corpus is maintained for a dark day. When the dark day comes, you cannot be prevented from utilizing it. There is nothing in the law that says you cannot utilize corpus. There is one more complication. I have seen the books of a charitable trust audited by the Big Four, in which it was prepared on accrual basis. It's the first error. In this case, there was a deficit in the income and expenditure account. For some reason, they did something called corpus drawdown, by which they reduced corpus to that extent and transferred to the income and expenditure account. It baffles me why you would ever do this. What promptly happens, the assessing officer says that in your computation of income, corpus drawdown is shown to the credit side of your income and expenditure account, You are not offered to tax, but you added that back to tax and levy, added that back to the income and levy tax. So please don't do such foolish things. And also the other fun, I'll come to your question. The other funny thing is, after doing corpus drawdown, the income and expenditure account still shows a deficit. So why did they do it? Yes, your further questions?
No, relating to that only.
Yes.
My income and expenditure has a deficit that will go to
Yes.
reserves and surplus,
Yes.
and it will reduce my corpus
Yes.
under reserves and surplus.
Yes.
That's it.
Yes,
That is the right treatment.
that is what we should do.
Yeah.
This corpus drawdown is complete. I mean, it is ridiculous.
How does a trust decide what is a corpus donation and what's my charity? Unless the donor himself tells that it's a corpus, only then it becomes a corpus, or it is at the discretion?
The trust does not get to decide, the donor gets to decide. Let me give you an example. There is a decision of the Kerala High Court in Mata Amritanandamani Trust, where a donation, a voluntary contribution was made, and there was a written instruction that it is towards corpus, and the donation further said that the interest or any income earned from investing this fund will also form a part of corpus. The Kerala High Court said that in view of such a direction, the interest received from the savings bank account to that extent would be corpus donation. With great respect, I disagree with this decision. The words are voluntary contribution with the direction that they shall form a part of the corpus. Is the interest a voluntary contribution? No, it is consideration paid by the bank. Secondly, there must be a direction. Who must give the direction? How can the donor of the sum say that the bank should pay that sum towards corpus? So, in my view, notwithstanding the Kerala High Court judgment, the only way to determine whether a donation is towards corpus or not is whether there is a direction to that effect given by the donor. It is a different matter that you can still choose to credit a sum to the corpus account in your books, but it will be treated as 11 on the income and you have to apply 85%. Yes, somebody else said that.
Now the form also need to be filed for receipt of donations.
10B.
Right, yes.
Where we have to mention what is the purpose of the donation.
Corpus or general.
Purpose of
Right.
donation.
Okay. So there are two kinds of practitioners. One set know the law and do not know the forms. One set know the forms and do not know the law. I belong to the former. This is more true in GST. Any other questions? Thank you very much. I hope.
Thank you very much, sir. But I would like to ask one question, sir. How can you remember so many cases, sir? Wait. I remember in so many cases, sir.
The question posed is how I remember so much case law. The answer is actually that I have quite a poor memory, much poorer than you would suspect. There are two ways I do it. One is I have a cheat sheet with me, and the second is I am given lectures on. See, I'm a little frightened that I am being typecast. Whenever anybody calls me to lecture on something, it turns out to be on charitable trusts. So effectively, I have given similar lectures at least 4 times, and at least 3 times in the last 3 months. So at this point, if I do not remember case law, it is quite embarrassing. But my memory is poor.
Thank you very much, sir. Sharing your valuable inputs on charitable trust, sir. You have given a very good knowledge in this area, sir. Thank you very much, sir. Please, present moment to make. I would like to invite Vinayak to present moment.